delay. Thank you. So I think there's no delay in the audio, video, sync, etc., etc. We faced a little glitch at the beginning of the session yesterday. So if those things are fine, then good to go. Sure. So I just got a couple of requests from students regarding starting. I mean, going through the HR and other aspects which are a little bit easier. So going through those topics a little bit faster and then spending a little bit more time on those financial performance measures and non-financial performance measures, how to analyze a given profit and loss better for your report number one, that is your question number one. So like basically HR, and then you have your non-financial, sorry, not-for-profit organizations where it's more basically the same concept of triple E's, value for money, that you learn from your, maybe FR, FM, audit and all those papers. So they wanted me to focus a little bit more on this balanced scorecard blockchain, building block model and this stuff. So yeah, I'll try to figure it out and let's see. I'll try to do that, but yeah. No delay, everything is perfect. Okay, thanks for the confirmation. Yes. So let's just start our session without any further delay. So first one is the human resource management. So here we are not going to talk actually about HRMS as in not your regular M.B.A. HR related objectives or anything like that. What we are going to do here is basically nothing but how human resource related aspects can be utilized, or how can they impact or influence our performance measurement and performance management. So it is more about what kind of role does HR play in this particular, HR play in performance evaluation and performance management. So that is our point of view. That is our thought process for this particular topic. So in this topic, the most important thing for you to know is first one, introduction to HRM. Basically, how do you manage your people or other employees in your organization, the workforce of your company? How do you evaluate them? How do you manage them? That is what is the purpose of HRM, human resource management. The most important thing in this particular topic are 2 points. First one is what we have already covered in our yesterday's discussion. That is what gets measured gets done, what gets measured and fed back gets done well, and then what gets rewarded gets repeated. So yesterday we have already spoken about this and we have discussed a little bit more on this also. So I'll move further. Then what is the other purpose of having HRM in our organization, human resource management? The major purpose is to assist in achievement of strategic objectives. What kind of role does this HR employees and other workforce of your organization play in reaching your strategic objectives? Basically the bits and pieces of your mission statement. How are human resources of your company, contributing towards the organization's success, overall success? That is the major key point for us. So apart from that, like providing a fair and consistent basis for rewarding the employees, there should not be a random lucky guess or lucky draw for giving the hikes to employees. There should be a proper standard. There should be proper metrics, or we can say there should be proper targets in place. So employees should be aware that, okay, if I hit these 2-3 targets, or if I meet these 2-3 goals, then I'll get this much amount of hike. The reward for the employees should be clearly specified, so there will be more motivation to the staff to enhance their performance. There will be proper rewards. There will be control over the cost of salaries, obviously. Then you'll also be meeting with the legal requirements by having proper HRMS. Sir, I can say legal requirements as in case if I'm taking an Indian organization, you know that employee related, we have labor laws like employee state insurance schemes or provident fund schemes, or else we can say tax deduction at sources regarding the employees, professional taxes to be paid by all the working employees. So there are so many legal and compliant aspects. So having a proper HRMS will also contribute towards meeting those or complying with those rules and regulations. So these are and also maintaining a proper attitude of employees so that they all align with the organization's overall culture. So these are all the purpose of having HRMS. The most crucial one for me is these 3, what gets measured gets done and all that stuff. And apart from that, the next important thing in HRMS would be Hopwood's management style. So, okay, before going to Hopwood, we are just going to talk about what are the pays that you will get. So obviously you have different types of methods of rewards that you are giving to the employees. Most of the companies just give a bonus. As simple as that, they'll just call it as bonus, and they'll be like, okay, at the end of a year or at the middle of the year or during a festival or whatever it is, they'll be just like, okay, your performance is good, so we are giving you this much bonus. As simple as that, they'll keep it like that. Or else you can also do some certain other things like target oriented bonuses, or else you can call it as maybe a random name, or different kind of names can be given. Whatever you are doing, that's fine. There are different methods of rewards. What are those? Obviously, your first basic pay will be there, your salary that you have agreed when you entered into the company. Then the company might also provide you certain benefits as in your perquisites. Company providing you a car, company providing you a place to live, company is paying your children educational fee, company is paying for your parents medical fees. So all this stuff, company is giving you direct benefits other than in cash, basically. Those are perquisites, we call it as. Apart from that, you also could have executive share option schemes. We call them as sweat equity shares or ESOPs, as you have learned in your SPR. Employee stock option plan would be there. So the employees of the company can also get shares of the company as a reward for working with them for over a period of time. You know, IFRS 2 share-based payments, you might have learned IAS 19 employee benefits. So all those things. Then apart from that, there could be a performance related pay. So the more you perform, the better pay you get. So a target oriented pay could be there. These are all different types of pays that a company can give to the employee as a reward. And whenever you are talking about this kind of rewards, they should be linked to a performance measurement. So we already learned about SMART objectives: specific, measurable, achievable, relevant, and time bound. So these 5 types of targets should be there. You give them a proper target and say that if you meet this target, then you'll get this much bonus. So keep it straight, keep it transparent, keep it clear when it comes to performance related pays. And also, most important one, those targets that you are setting, they should be controllable by the employee, as in their performance should either give them the bonus or not give them the bonus. There should not be anything which is out of their control. You cannot tell your employee that if suppose tomorrow Sri Lanka wins the match against, India Zimbabwe match is going on right now, right? If suppose India wins tomorrow's match against Zimbabwe, you will get 10% hike. It is uncontrollable by the employee. It is out of their reach. So such kind of targets should not be there. The targets should be controllable by the employee, and there should be proper prioritized targets. Like this is most important, this is second important, this is third important. There should be priority, and then they should be rewarded according to their targets that they have achieved. Then talking what are the advantages and disadvantages, and then regarding problems of poorly designed performance measurement system. So this is something that I would expect in question number 1 of your examination. Your 50-mark question can actually consist a portion of this part. What is that, sir? You know, if your performance measurement system or reward based system in your organization, these are the things that could be creating problems in the measurement system, or this could be the flaws in the existing system. So to be very honest, when I gave my APM examination myself, for me, I got gaming, myopia, and tunnel vision. I got these 3 in my examination. So please make sure that you go through all of this. I cannot actually tell you all of that. Just I'll give you a couple of them for relating to the topic easily. So misrepresentation. The employees might misrepresent that. They might not have actually done something, but they can misrepresent and tell you that, yes, we have done this. They can show the numbers differently to you. They can manipulate the sales numbers or something like that, targets and other things, and they can misrepresent the facts and figures to you. Similarly, gaming means all the employees are coming together and they are trying to manipulate fake customer reviews or wrong samples. Yes, that is misrepresentation. Agree. Then gaming is basically where they manipulate the employer himself. Like all of them team up and they'll tell you that, sir, these things, whatever targets you are setting, none of the employees will be able to achieve it. All of us are feeling the same thing. So they try to manipulate the employer himself. All of them teaming up. That is called gaming. Similarly, sub-optimization means willfully and intentionally performing below their optimum level, like reducing their maximum output so that targets will be reduced in the subsequent periods. Suppose if I always score 95, my teacher's expectation on the student will increase. They'll be like, next time you should get 98, 99, 100 out of 100. But if intentionally, if I reduce my score to 70, 75, 80, something like that, then parents and teachers, they know that average 70, 80 ke beech mein aa raha hai. So let's give him a target of 85 or 90. So that is sub-optimization, like that. You can go through the rest of them. Tunnel vision is the most crucial one, I can say. Tunnel vision basically says that they only focus on one aspect of the performance measurement. Like when you have a helmet on your head, for example, you're driving a two-wheeler and you put on your helmet, what will happen? It will block your vision so that you can only see what is in front of you. When you are wearing a helmet, you cannot see your sides. So it will restrict your perspective. It will restrict your vision. That is tunnel vision. So when you give some targets to the employees, they only look at that target. They only focus on achieving that target rather than looking for overall customer satisfaction, overall wealth maximization, overall benefit, goodwill generation of the company, brand image building of the company. They'll not look at all that. They'll be like, I need to meet my target. Their focus is only on the target. So you can just go through these things. The remaining ones, I cannot, this is not a regular class. You guys do understand that. Doing what's easy to the determinant of other KPIs. Yes. Basically meeting your target, not caring about the rest of the aspects. So let me tell you one thing. It's good, Vivek, saying that doing what's easy to determine to the detriment of other KPIs. Yes, this is good, but also understand one thing. That's a nice way of explaining things, but make it easy for the examiner. That will make it easy for them to give you marks. I'm not saying that examiners won't understand what Vivek just said there. It's basically like doing what is easy so that other KPIs might get detrimented. But examiner may or may not understand it. Why take the risk? Make it easy for them to understand. But keep it professional when it comes to proper terminologies. Don't change the terminologies. The regular explanation that you do, try to keep it easy for them to understand. You may just say that employees may just focus on meeting the targets, ignoring the other aspects of growth. Simple, so that everybody can understand. Just a small suggestion, that's all, nothing more than that. Now coming to the management styles, Hopwood management style. So Hopwood is the person who proposed that there are different types of styles of management of employees. So the most crucial ones, that doesn't mean these are the only types of styles. A new HR may come and he can have a completely different style of management. We can't comment on that. The typical styles of management are covered by Hopwood. He says that first there are budget constrained managers. Budget constrained manager is a guy basically who, a person, not a guy. So budget constrained manager would be someone who is only constrained by the budget. They are like, okay, as long as you are within the budget, it's fine. We do not have a problem with you. So I'll give you a maximum budget of, let's say, an expense related budget. So maximum you can spend only this much. So as long as you are within that budget, I'll not question what you are spending and on how you are spending. I'm fine as long as you are meeting the budget. Similarly, if you are a sales guy, minimum you should sell this much. Beyond that, you get your performance related pays. I do not mind. As long as you are meeting the budgets and meeting the targets, we are happy with it. Those are the kind of managers who are constrained by the budget of the organization. They do not look beyond the budget. Then there are profit conscious managers. They are like, okay, you may not meet the target, but as long as your actions are good for the profit of the company, whether short-term profit or long-term NPV maximization, wealth maximization, short-term or long-term, it's fine. But as long as your actions are good for the company, we are okay with it. You may not meet your target all the time. Okay, fine. So see, for example, yesterday we were supposed to close it by 3 hours. We were supposed to complete the syllabus, but I did not meet that target. We are extending the lecture a little bit, but end of the day, that is useful for the students. Even if I take that extra couple of hours, so it is worth it. So as long as the end result is meeting, we are fine with it. That is profit conscious. Managers' rewards are linked to the achievement of long-term profitability, like NPV of the target or something like that. But the most recent style is non-accounting style. We do not restrict the employees on the basis of budget. We do not constrain them on profit consciousness or anything like that. Simple thing is, I do not care about the numericals at all. The financials are not relevant for me. Non-accounting style focuses more on the other aspects other than financial aspect, maybe customer satisfaction, employee satisfaction, productivity of the employee. May or may not be directly giving financial benefits to the company, but we are looking at the longer period. We are looking at the non-financial aspect of it. We'll discuss more about this when we go to the non-financial performance indicators. Obviously, you guys know that that is the next topics for us, right? Those are the next topics for us. Chill. So that is your 7th chapter HR related. The most crucial ones is, remember those 3 lines. What gets measured gets done. What gets measured and fed back gets done well. What gets rewarded gets repeated. Then the Hopwood's 3 styles: budget constraint, profit conscious, and non-accounting style. These 2 are crucial in HR management. More than that, nothing is required. Sir, if you see BPP, I'm facing some minor lag issues in between. Is it just me? I don't know. Others need to confirm. God, not again. Oh. No, it's actually my network only. I don't know why I paid for 150 Mbps and I'm getting 50 Mbps speeds. Yeah, I'll have to call this ACT people and say that if you guys don't know how to provide proper internet, just get out. 55 hours. It's too bad. Just, is there something that I can do here to make it better for you guys? It's definitely my internet, guys. It has nothing to do with you. But is it okay now? I just turned off my mic and using the camera's mic. I think you guys do not see any difference in this. Yeah, still no difference. Okay, let me switch to 2G then, maybe. Better signal or something like that. Can you hear me now? Yeah, is there any difference? Like, is it better now? Yeah, okay, cool. I think the problem is with signal. I had to switch from 5G to 2G, and I guess it is better now. The signals are a little better, I believe. Yeah, better it seems. Once, can you confirm, Vivek? Is it good for you and KT? Can you guys once confirm? Is it good for others also? Yeah, okay, cool. Chalo. Let's continue then. So that is about your chapter number 7. Then moving on to our next topic, which is the most, I believe, not the most important one, the second most important one, I can say, the financial performance measures in your private sector. Sir, here, this is the topic which you learned in your financial reporting as interpretation. The same is repeated in audit and assurance as ratio analysis. The same is repeated again in first one would be the next topic, which is the non-financial performance measures. That would be the most important topic in your APM syllabus. Anyways, let's just get to that. We'll get to that. I know you guys need more like, sir, concepts are good. We'll learn that, but tell us the most important topics for examination. Your focus is on that. I understand. Cool. But having said that, coming back to, you have learned this topic in your FRS interpretation. You learned it in audit and assurance as ratios, or we can say analytical procedures. Basically, within that substantive procedures, under analytical procedures, test of details, you might have learned in analytical procedures as ratios. The same is repeated in F9 as again ratios. Then it is also repeated in SBR in interpretation of financial statements. It is there in SBL. It is there in APM. So basically every topic, every subject of your ACCA curriculum has this ratios or measuring the performance of the company. Isn't that what chartered is all about? Like knowing the financial statements of the company. So this is the second most important topic, financial performance measures in private sector. So to be very honest, sir, even I'm not even worried about looking at the content of the topic. First, I'll just directly go with the ratios. And the crucial one, what I do is I split my ratios into different categories and I'll play with each category. So that is how I learn it. So what you can do is your entire ratios, we usually split it into 4 parts in our regular classes. What are those 4 parts, sir? The first one would be profit related, or I would rather call it as, instead of calling it profit related, I would call it performance related ratios. Okay, then liquidity related ratios, then my risk related ratios, And then the last one would be other miscellaneous ratios. This is how I usually classify my ratios. Sir, there could be other 10 types. I don't mind. I would just, all of them, I'll put them in the last category, miscellaneous ratios. So performance related, the most important one would be GP ratio, talking about your gross profit margins, then your net profit ratio, then your ROCE, return on capital employed, then you have your ROI, which you will learn in divisional performance measurements. Please be very careful about this. ROCE and ROI are not same. They are not at all same. Return on capital employed is different. Return on investment is different. And at the same time, you also have something called ROE, return on equity alone. So ROCE, I believe you guys already know the ratio calculation of ROCE. It's basically return upon capital employed. That return would be PBIT, profit before interest and taxes, upon your total capital employed, which includes your equity plus long-term liabilities, right? Whether it is the debt capital or whether it is equity capital, our ROCE talks about the entire return that our company is making before paying off to the debt holders. So that is profit before interest and taxes. Sir, if you ask me really, sir, but then out of this, we also have to pay taxes to the government. Now, sir, taxes is not really written for us. So I would say, technically, not for examination purpose, technically, the correct methodology of calculating ROCE would be PBIT into 1 minus tax rate. Because taxes are to be paid to the government. Sir, but for ACCA exams, is it required? No, no, do not do this part. Only take PBIT by capital employed. It's fine, no problem. Am I making sense, sir? Sir, but then again, this is not our regular class, so I'm not going to go into the details of these things. I can just give you a basic level of introduction, but not go into the depth of it. So let's not go into that. Anyways, moving further. So where is this? Yeah, here. Okay. And then ROI is divisional version of ROCE in it. Okay. So basically, ROCE is written on the total capital employed in the business. Please understand this. You employ your capital in the business, whereas you invest in a particular division. Please understand that. If you understand that, you will understand the difference between ROCE and ROI. You employ your capital in the total business. The business will make investment into different divisions. So that is why when you call return on capital employed, you talk about it on the overall business level. But if I'm talking about each division of my business, I'll only calculate the return on my investment in that division. Please confirm in the chat section, everybody, is that explanation clear? So we employ the capital into business. And the business will make investment into divisions. So on and so forth. So that is your crucial thing. So when you calculate return on capital employed, it is for the overall business. When you calculate capital return on investment, that is investment in each division. That is why ROI is a divisional performance measure. ROCE is a business performance measure. Be very crucial and careful about that. Similarly, return on equity will only calculate the return for equity shareholders. That would be your profit after tax minus your preference dividend, provided this dividend is on cumulative preference shares on which you have to mandatorily pay the dividend. And if it is not actually shown in finance cost, and if it is taken from retained earnings, then we have to subtract it here. Sir, I did not understand all that. No problem. That minus preference dividend, you understand. See, if you go back to your IFRS 9 financial instruments, preference shares can be classified either as a debt or they can be classified as equity based on whether they are cumulative, non-cumulative, participatory, non-participatory, redeemable, irredeemable, all that things we'll see. It is showing my internet connection is unstable. I believe it's fine for you guys, right? Please confirm the chat section. Is the audio, video and screen sharing still fine? Kiran says it's lagging again. Lagging. Yeah. Even Zoom is trying to tell me the same thing. Just a second, guys. Just a second. I do not. I'm trying to just disconnect and reconnect again to see if it improves the connection speed. I'm getting 20 Mbps. Yeah. You pay for 150 Mbps and you get 20. That is shitty. Smooth for the last few minutes. Yeah. Or else it could be also the fact that I changed my desk location in my house. Maybe the signals in this area of the house could be a little big. I'm not sure. I have to figure it out maybe later. Yeah, possible. Yeah, it could be possible that the location, the change in the location might be reason for signal data. But is it fine now? Or is it still laggy? Really? I do not see that in the recording. The recording, it is showing very bad quality. Yeah, it's fine now. Chalo. Let's continue, sir. Already we are on delay. Already we are late on our syllabus. So let's continue fast. Okay, it's fine then. Let's move further. So profit after tax minus preference dividend. So if you see your IFRS 9, preference shares can be classified as debt or preference shares can be classified as equity. So if they're classified as debt, then again different accounting treatment will be there. If they're classified as equity, different treatment will be there. That dividend on preference shares can also be shown in finance cost, or dividend on preference shares can also be shown in retained earnings along with equity dividend. So let's not go into the details of that. This is not SBR exam, but after payment of preference dividend, after payment of interest, taxes, dividends, everything you paid except for equity, divided by total equity. This will give me what? So this will give me return on capital employed. So, sorry, return on equity. Me who skipped the entirety of IFRS 9 in SBR. Oh God. That's very bad, sir. That's one of the most nicest topics in SBR. That's one of the value adding topic in SBR. There are so many topics which are like just repetition of what you already did in FR. IFRS 9 is one good topic where there is value addition. But yeah, not just you. I have seen so many, you might be kidding, but there are so many students who have skipped IFRS 9 because whatever reasons. Let's not go into it. But yeah, coming back. So those are performance related. But apart from this, there is one, my favorite performance related ratio, which is not covered here. That is your asset turnover ratio. I love that ratio. I don't know why. It talks about how well you are able to utilize your assets, isn't it? It says that if I have 100 in assets, how much sales am I making? If I increase that investment in assets from 100 to 500, how much will my sales grow? So it basically tells you, see, if as a, I can say as an investor, maybe I would love to see the asset turnover ratio of the company. ROC, PE, all these things are fine. Asset turnover also is very crucial for me, because if I give my money to the company, will they be able to generate sales with that money or not? And I will not just look at the asset turnover ratio and say that, okay, with this much of assets, you did this much sales. So if assets increase, sales will increase. No, I'll also like to know how they are planning to increase their sales. Is it just that there is sufficient demand in the market, but we do not have enough resources to meet the demand? Or is it that we are already struggling to push our product into the market, sir? So even if there is a scope for investment, I don't think we can make best use of it. So we need to understand asset turnover plus non-financial data of that as well. What is the market position of your product? Is it a star product? Is it cash cow? Is it a dog? Is it a question mark? Which category is that product falling into? Right? So we need to understand, see, not just financial performance measures, guys. Use the ratios along with the non-financial data. You need to know how to balance these two. And you should also know how to link these two. Financial plus non-financial. That is how a proper analyst would analyze the company. Okay, there are so many companies with scope of sale, but unable to sell because they do not have the resources behind them. Maybe the capital, maybe time, maybe human resources, maybe technological, maybe skill set, whatever it is. There are so many companies with large amount of capitals and they are unable to use that properly. ITC is one of the best example for this. You see, ITC has been giving a constant dividend of approximately 10 rupees for as long as I remember, maybe for the last 5 to 10 years, I believe. 200 rupees worth of share giving 10 rupees of dividend, which is 5%, which is 5% not on the face value, sir. 5% on the market price of the share. Like that's too much. A fixed deposit in market is giving you 6%. Bankers are paying only 6. If a company is giving you dividend of 5% plus capital gains again, that's damn good. So, but why is ITC doing it? Because they do not have any growth plans. They do not have any interest in expanding further. They do not have any use with that money. So they're distributing it back to the equity holders in the form of dividend. They're like, no, we do not want to expand into further markets. So we need to also understand that there are financial and non-financial things that we have to read together. So that is about it. So talking about the most important thing about ratios, so there's no point in actually going through all the ratios and giving you the formula. Okay, that is not my thing. In my regular classes only, I teach the meaning of the formula and I'll go further. I do not do calculations on formula. What is there in that? You just take the question, values from the question, put it there, use the calculation, and then write the answer over there. That doesn't add any value to the student. So I'm not interested in teaching you the ratios. So I explained you the major purpose of that. And then we know that business has the major motive of maximizing the wealth of the shareholders. That is true. Then in this area, the most important thing I want you to know is, please know the problems associated with the ratios as financial measures of performance. Problem number 1, this talks about historic information. Sir, all the ratios are calculated on the basis of financial statements, which are all historic. None of the ratio actually talks about your future plans. Maybe Gordon's growth model may tell you a little bit information about future price of the share, but then again, that is also wrong because you just use IRR. NPV is not really a financial performance measure as such. It is actually an investment appraisal tool. Whether I should invest in a project if it is having positive NPV, or I should not invest in a project if it is having negative NPV. It's not financial performance measure as such. It's more like an investment appraisal technique. So I don't think there is any ratio which actually talks about your future prospects. Actually, all the ratios, to be very honest. So the most critical thing that you need to talk about ratio analysis or financial performance measures is they're all historic information. They do not talk or they do not represent the future expectations of the company. That is the first point. Second one is all these numbers can be easily manipulated. I tell this very simple example for my students, sir. At the end of the year, I can say, suppose if my sales are very bad, I did not meet my targets, I can make a fictitious sale to one of my relatives, one of my friends, or one of my colleagues. I can just make a fictitious sale, record it on 31st of Jan or 31st of March or 31st of December, record a sale. After a couple of days, new financial year will begin, and then I'll record a sales returns. So last year sales have increased, current year sales will be decreased. So last year ratios are all manipulated. Similarly, I can switch from straight line method to return on value method and increase or decrease my depreciations and play around with my numbers. I can ignore impairment losses. I can calculate the fair value with bias, or I can say the fair value has actually increased and I can show revaluation gains. Maybe that is true fair valuation or maybe that is false. Auditors might see it, might not see it. Auditors may be able to figure out that, I don't know, this fair value calculation is wrong. Maybe they are aware of IFRS 13, maybe they are not aware of IFRS 13 fair valuation. Whatever, sir. All the ratios are basically numbers which can be manipulated. So these are the critical points about using ratios as a performance measure. You need to know that. And next one, these ratios by themselves do not say anything. They give sometimes meaningless information. I'm being very rude here, I know, sir, but whatever ratios you are calculating, they are so dumb sometimes. They are all giving useless information. They are giving false information also so many times. I have seen companies calculating certain ratios and then giving wrong interpretation to the shareholders. That's easily possible. You need to look at the linkages between different ratios and then figure out that achha, this ratio is increasing means I'll have to look at another ratio and figure out whether that is also increasing or not. Let me tell you a simple example. What happens if the closing stock is increasing? Will there be increase in profit or decrease in profit? So if closing stock value is increasing, will my profit raise or will my profit decrease? What happened? No response. Profit will rise. Yes, correct. Yeah, very good. So simple question. Is that really a performance related aspect? What if the company switched from FIFO method to LIFO method? Now you might say, sir, LIFO is not approved, no, sir, it is not accepted in IFRS. Ma, if you go and look at US GAAP, LIFO is absolutely allowed. There is no problem at all. IFRS does not allow LIFO. I believe, I agree. I truly agree to that. But there are some countries where LIFO is accepted. So if they switch from FIFO to LIFO due to inflationary conditions, actually the other way around. If they switch from LIFO to FIFO, what happens is the stock in our hand will be talking about the last received stock. So if the conditions are inflationary, the value of the closing stock would be higher. So the profit might increase, but is it really related to the performance of the company? Absolutely not. It's just a change from LIFO method to FIFO method. So in FIFO method, what we'll do first in, first out. So the stock in our godown would be basically usually from the last batch of goods we purchased, which could be at a higher price. So stock value is a little higher. Simple. So that is not at all related to performance. So never look at ratios in isolation and then say that last year se compare karte hain, and maybe compared to the last year, this year's GP margin has increased, NP margin has increased. Fine. Also understand the reasons for those increase. That is more crucial. So it is all about having a critical approach. You need to know the flaws in the performance measures and then telling what. Just do not look at the ratios. You have already done that in FR, financial reporting. You said that, okay, the gross margin has increased by 10%. So the company is making good operational management. No, that is only for FR. When you come to APM, you also should say that the gross profit margin of the company has increased, but we also need to look at the performance related or operational related aspects and figure out that if the increase in the GP is because of changes in accounting methodologies or is it because of actual improvement in the overall performance of the company. You need to have that maturity. Am I adding any value or am I just repeating myself? Right? Okay, thank you. Then you also have meaningless calculated in isolation. As I told you, read between the lines, look at combination of ratios. Do not look at each ratio. Sir, GP ratio increased. Very good. Very good. That's fine. No problem. Immediately take a look at inventory period. You have your inventory calculation, right? Inventory days, you might call it as. Inventory divided by closing stock divided by cost of goods sold into 365 you will do. It will tell you the number of days worth of stock in your godown. Now see, if suppose your GP margin is increasing, at the same time your inventory days are also increasing, it means basically your profit is because of increase in inventory. Then go and look at inventory in the balance sheet and think, is there any change in methodology of accounting? If yes, good. If no sir, methodology is not changed. Last year also we used FIFO, now also we are using FIFO. Then also look at the thing that inventory is increasing, which is showing that company may not be able to sell their inventory. Maybe their sales are reducing. Or is it because the company has made a purchase at the end of the year, because of which the inventory is actually showing you more inventory? Like I purchased exactly on 30th of December, sir. I received the goods on 31st of December. I do not, it's just basically the end moment I received the inventory. So in that case, your inventory would be obviously higher. Why not look at revenue and profit instead? That's what I'm trying to tell you. Do not look at one single ratio at a time. Isolated, do not follow that. Combinedly, you need to do the ratios. Sales growth, inventory growth, cost of goods sold growth, and then GP growth. Then collectively, you have to do an analysis and say that, okay, the increase or decrease in GP is because of operational results or because of non-controllable factors. That is how you should be critical about it. Right? Chalo. Next one. Performance management advice should be based on what you have calculated. I would be actually correcting that statement. What you have calculated and interpreted, analyzed, whatever you want to call it. Chalo. So profitability related ratios, you have ROCE, EPS, earning per share. Then you have EBITDA. So this is not a ratio, this is a number. Be very careful, ma. Some of them are percentages, some of them are numbers, some of them are decimals, some of them are dollar values. See, for example, ROCE is a percentage. EPS is a number, it's a decimal. EBITDA is a dollar value, it's an amount. So be very careful what you are calculating here. All of them are not really ratios, some are percentages, some are values. So EBITDA talks about earnings before your interest, depreciation, taxes, and amortizations. So I believe there is this meme. I don't know if you guys have seen it or not. I remember sharing it on in our Telegram group and channels as well. Like there's one small picture where they'll show that EBITDA is like they're making some leafy curry, and then EBITDA will be this much, and then what is that? Profit after taxes will be half of that, and then available to shareholders would be a couple of leaves. Like that. Basically, EBITDA shows very big value compared to our actual profits. If you remember in your CTC memes, similar to that, when you talk to a company, they'll be like, your CTC is 20 lakhs, but what you get in hand is 12 lakhs. Why, sir? Taxes, professional tax, then your income tax, then you have your gratuity deduction, then there is PF deduction, then there is ESI deduction. There are so many nonsenses, but whatever. That's EBITDA. Then you have your other profitabilities like EVA, economic value added. We'll talk about more about that later. Then you have asset turnover, as I told you, my favorite ratio, asset turnover ratio, dividend coverage ratio, dividend yield, price earning ratio. It's actually PE multiple, but that's okay. Earnings yield, return on equity. So return on equity talks about, here they are talking net profit after tax. So this is why I do not trust books. I don't know. I do not trust these publishers sometimes. Net profit after tax. Sir, if your preference dividend is actually non-cumulative, if it is non-cumulative preference dividend, then that preference dividend should be treated as equity dividend, which will be deducted from retained earnings in statement of changes in equity. If that is the case, if there is non-cumulative dividend paid by the company on preference shares, here the formula would be net profit after tax minus preference dividend divided by average shareholders equity. That minus preference dividend should have been included here. But then it would be very difficult for Kaplan to explain that to a student. So they'll take that liberty and say that it's net profit after tax. I would not take that liberty, sir, because I do not want any student to come back to me and say that, sir, but you said that, but isn't this against the logic? I would rather be confident on my logic rather than what is given in a textbook. Same thing happened with, I think Vivek and I were talking about it a couple of days back. Same thing happened with associate accounting related adjustments in FR. Something was given wrongly in both the Kaplan and BPP textbooks, both Kaplan and BPP actually. And when I taught the right one, I had to fight with college faculty and college commerce HODs because they say that, sir, you should not say textbooks are wrong in front of students. I'm like, no, if it is wrong, it is wrong. Simple. It's illogical. ACCA has corrected that for this September 2022 onwards. It took them 4 or 5 years to correct that. So yeah, things happen, sir. It's nothing wrong in that, sir. ACCA, Kaplan, BPP, all of them are of the opinion that students might not be able to understand the logical explanation. It might become too much difficult for them. But then who are we, sir? If that is the case, do not include that topic. Remove that from the content. Syllabus में से निकाल दो उसको. But keeping it in the syllabus and teaching wrong doesn't make sense to me. But anyways, let's not waste time on that. Then you have your NPV, IRR, MIRR. So modified IRR. I don't think you guys have actually gone through MIRR, right? Or did you guys do some problems on MIRR as well? I know it's very lengthy calculations would be there, but if you do it on Excel sheet, it's very simple. Yeah, in masters, not in ACCA. Please do it in ACCA also, sir. You have MIRR in APM and AFM as well, but the calculations are slightly different in AFM and slightly different in APM. But then if you're doing it on Excel, yes, it's easy. So that's the thing. Find a faculty who teaches you it on Excel so that it makes sense to you. But if they're teaching you from a textbook, it looks so weird. So anyways, MIRR also try to do it once. Then you have your liquidity ratios, current, asset tester, inventory, receivables, payables, very common things. I'm not going through the ratios. Financial gearing ratio, operational gearing. Okay. I believe you guys someone had doubt on operational gearing and financial gearing. Last time I spoke, Vivek also asked me operational gearing, right? Yeah. Okay. So talking about financial gearing. So financial gearing is basically risk relating to the debt of the company. So usually, when we say gearing, we mean debt. But actually, the meaning of the word gearing is risk. So financial risk, operational risk. That is what they mean by financial gearing and operational gearing. Financial risk means what, sir? See, if you're having too much obligations on you, like there is so much money that you have to pay to your fixed obligations, like your debt, preference shares, redeemable preference shares, not irredeemable again. That is why I do not like this thing. See, they say long-term debt, sorry. Here they directly wrote long-term debt plus preference share capital, right? But actually it is long-term debt plus redeemable preference share capital. If it is irredeemable, there is no obligation on the company. It is not gearing for you. There is no risk involved in that. So it is only redeemable. It's not all types of preference shares. That is what I kind of have like a little bit problem with that. Okay, anyways, coming back. So divided by total shareholder funds, or else long-term debt plus preference share capital by long-term debt plus preference share capital plus shareholder fund. So basically your debt equity ratio. In simple words, your financial gearing only talks about debt by equity or debt by debt plus equity. Related to finances, money in business. Yeah. Okay. In simple terms, financial gearing is debt by equity or debt by debt plus equity. Operational risk. Sir, what is the risk of running operations, sir? Every company has operations. So what is the risk involved in that? In simple terms, if you have too much fixed cost in your company, then you will have operational risk. How do I calculate contribution? Sales minus variable cost. That means other than fixed cost we are taking. So if you have too much fixed cost involved in your company, you will not be able to recover those fixed costs running into losses. So your operational gearing actually talks about contribution by PBIT. It's the profit related ratio. Okay, it is saying that how much amount of your profit is actually eaten by fixed costs. Right? Then you have your interest coverage, dividend coverage, all that nonsense. Sir. Then short-term financial performance measures versus long-term. Short-term, we might focus on profit. Long-term, we would rather focus on shareholders' wealth maximization, right? So we should try to reduce the short-term nature of the business, and we have to look at the longer period. We have to look at the value addition to the shareholders. So that is your financial performance measures. Then talking about divisional, as I already told you guys, when you talk about division, we talk about investment into a particular division. So you have your ROI, RI and EVA here. Then you have value-based management and transfer pricing. I believe all of you I actually got multiple requests on this thing. Like Vivek actually asked me, sir, ROI, RA, and EVA, please pay more attention on these details. And then Rose actually texted me that she has problem with the transfer pricing. I believe this divisional performance measurement related topic has become a little tricky for you guys. So I'll try to cover up as much as possible here. So we are down 1 hour, so we'll have to consider. Sure. No, sir. Even Kiran is also having problem in this area only. Okay, I'll do one thing then. If it is really that problematic for everyone, I would be okay in uploading my actual lectures videos, the full version, the paid versions of our lectures, whatever are there. From those lectures, I can upload economic value added and transfer pricing. These 2 lectures I can upload on YouTube directly, so you guys can get the full lecture rather than just a revision kind of a thing where problems are also solved. But yeah, that's an additional one. But let's do it as a part of our revision also. Then additionally, I'll upload them on YouTube. That APM playlist I'll upload. So let's do this. Chapter number 9, divisional performance appraisal and transfer pricing. So first part of this chapter actually talks about performance appraisal of divisions. Second part talks about the transfer pricing. So first part is appraisal of performance. So appraisal of performance, we use financial, non-financial ratios and all. So when it comes to divisions, we do ROI and we do RA. So what is ROI? Return on investment. Please understand one thing here. When you do return on investment calculation, it is only controllable profit. Controllable profit of the division divided by controllable investment in the division. So what do you mean by controllable profit? What do you mean by controllable dividend? Transfer pricing, Vivek, did you share edited version of the transfer pricing chart? Okay, let me ask you something. Why is there an edited version? Is there something wrong that I did? What is the reason for editing? I just made it look fancy. Okay, fine. If that is the case, that's okay. I'm bad at making things look fancy and all. I'll just give a handwritten notes to my students. I do not add all those animations or any kind of pictures and all in my notes. Acha, this guy just added so many pictures to this. He made it colorful. Nice. Division A, Division B. Okay, cool. Okay. Nice. Good. Chill. I'll use that chart in today's lecture if you don't mind. Okay. Cool then. With full credits given to you. So here the key word in talking in ROI and ROCE is control. Sorry, not ROCE. ROI is controllable. Sir, what do we mean by controllable here? Sir, let me take a couple of minutes more here. I know we are less on time, but still, since this is one of the problematic areas for you, I would rather spend a couple more minutes on this. So let me just pick up and okay. Imagine like this. So there is head office, and what this head office do is they send money for 4 different divisions. So we have division A, division B, division C, division D. Now, what this head office did is they sent total, let's say, $100,000 to division A. But at the same time, head office also sent an instruction to this division A that out of this 100,000, you have to spend 20,000 on advertisement. And they also specified this advertisement should be for, let's say, a FIFA. There is one FIFA, what do you call it? Football. Some people say football, some people say FIFA. I don't mind. I'm not a big fan of it. But there is one tournament that is going on, a gaming tournament, sports tournament, whatever you want to consider it as. And in that, advertisement should be given. For that advertisement, 20,000 should be spent. Now, this division A manager has actually made a profit of, let's say, 15,000. Now, if I'm calculating ROI, return, head office is like, we gave you total 100,000, you got us a return of 15,000. So you are giving us 15% return. But that would be wrong. The division A manager would be like, sir, who told you 100,000? No, you gave me 100, but you specifically told me 20 should be spent on something. Actually, you know what happened, sir? None of the people in the region where division A is located, they watch FIFA. None of them actually pay attention to FIFA. And because of that, there is no increase in sales only. It's absolutely useless for me. But you told me that it is mandatory to spend on that. So why are you calculating ratio on 100,000? No, remove this 20,000, calculate this 15,000 as a percentage of 80,000 out of 100 minus 20, 80,000. That means approximately they are getting how much? 15 by 80, 3, 20, 16.67, if I'm not wrong. I don't know. My math has been a little rusty these days. $18.75. Okay. 18.75 it seems. Whatever, sir. Let's not worry about the value, but yeah, it's much higher than 15%. It's 18.75%. So that is why ROI is basically a controllable profit by controllable investment. If something is out of the control of a particular division's manager, will not consider that. And to eliminate that nonsense part, and then you have this explanation in your APM Kaplan textbook, wherein they talk about because of depreciation, the value of the investments, the value of the denominator keeps decreasing every year. So if a company is making 10,000 profit constant, 10,000, like this constant 10,000 profit they are maintaining, but the denominator investment in the assets is reducing because of depreciation. So there is actually no increase in the profitability of the company or performance of the company, but the ratio keeps increasing because there is a decline in the denominator. Denominator is decreasing, so the ratio is increasing. So ROI has this flaws in it. So to overcome that, we'll go with RI, residual income. So under residual income, what we'll do, we'll take notional interest. So what is this notional interest, sir? So notional interest, what we'll do, basically our weighted average cost of capital. So what is your total profit? What is the weighted average cost of capital of the company? So if I subtract weighted average cost of capital from the profit of the company, the differential that is left is actually residual income, leftover income. So here you are already paying everybody what they expect. And still, if you are left with money, that is a good position for the company. So the higher the RI, the better it would be. But the problem with RI is it's an absolute number. So you cannot compare one company's RI with another company's RI. But ROA is a percentage. Return on investment is a percentage. So you can compare company on company. Are you all following this, sir? Yep. Very good. Nice. So that are the problems associated with the divisional structure. Let's just quickly go through that. The first one would be controllability. Yes, some of them are controlled, some of them are not controlled. Coordination could be different. The coordination could be inappropriate between the different divisions. One division may not be in good sync with another division. There could be dysfunctional behavior. Means what, sir? Dysfunctional means something which is not for the overall benefit of the company. Dysfunctional means focusing on divisional growth rather than focusing on divisional performance only. We are not looking at the overall company's performance. Only the divisions we are worried about. Being selfish, dysfunctional. Suboptimal decisions. We might take decisions which are not good for the overall company, which are only good for the division. So we might take such kind of decisions. Then interdependence. One division may be dependent on another division. So if that division is not performing properly, that will impact my division also. Or there could be head office costs which are allocated to different companies. Sir, I believe you guys might have done a question in PM, performance management, where because head office costs are allocated to different divisions, one division is in loss and the company directors actually plan to sell that division. But then later, a consultant will come in and then he'll be like, sir, let me just do the calculations independently. And if they do not include head office cost, that division is actually running in profits. So such kind of questions were there in PM. If you might have got exemptions or anything, you might not have known it, but that's okay. You understand the concern, right? Then how transfer prices should be set. So transfer pricing related, we'll discuss along with the chart. Then different types of responsibility centers. You have your cost centers, you have your profit centers, you have your investment centers. Cost centers means only costs are incurred. There are no returns, there are no profits. Maybe an accounting department, HR department. There are only costs for this. They do not directly generate any revenue. So that is why accountant salaries are much less compared to software engineers. We are cost center for a company. Software engineers and software department is profit center for the company. Research and development is a cost center, right? So like that. So these things only generate cost for the company. There is no returns. Profit centers will have both cost and revenue associated with them. So there will be profits or losses. Investment center also invests in the business. So for cost center, you can only calculate cost related ratios, increase in cost, decrease in cost, variance analysis, etc. Profit centers, you can also do profitability, ROCE, PBIT margin, gross profit margin, net profit margin, all this stuff, asset turnover ratio, etc. Investment center, you can do NPV, IRR, discounted paybacks, ROI, RI, EVA, all that you can calculate for an investment center because there is putting the money into that centers. Then concept of ROI and ROI. So this is divisional equivalent of ROC. As I told you, ROC is for the overall company, ROI is for a particular division. So that is a major crucial thing here. And controllable profit by controllable capital employed. So this should not have been capital employed. It should have been controllable investment in the division. Okay, but cool. Not to be concerned, not to be worried about it. Let's not make it a big deal. So if the ROI is greater than the targeted cost of capital, so if my returns are more than my cost, I'll accept it. If returns are less than cost, I'll reject it. So as simple as that. So what if these two are equal? Reject it. If return on investment is equal to cost of capital, that means you are breaking even. Why do you want to take up a project which just breaks even? Why do you want to use all your resources for just recovering the cost without any profit? Reject it. As simple as that, reject it. Next one. But do not use that logic for NPV calculation. So at the time of NPV, everybody know if NPV is positive, accept. NPV is negative, reject. But that is fine, sir. What if NPV equal to 0? Should we accept or should we reject? Can I get an answer? If NPV equal to 0, should we accept or should we reject? Don't tell me optional, choice, etc., etc. No means you should not accept the project. Okay. What do you think, Vivek? Kiran, Katie, everybody, please respond.
I think if the project could fetch something more than just the financials, it could be done. Not just talking about the profits. If that's going to sort of boost up the company's reputation, why not go for it?
Good. You are talking about the non-financial aspect of it. Very good.
Yes.
So what if it's a mandatory project? What if it's a government project? Maybe sometimes even if a negative NPV also, I might accept the project. Maybe because it can give me further projects, further contracts, which are more profitable. I'm trying to build a value. I'm trying to build a brand. So I might accept projects that are even breaking even. So that could be another reason. But apart from that, financially speaking, if I use my, listen to me very carefully, if I use my expected return for discounting, NPV, you discount the future cash flows to present value. So while discounting, if I use my expected return, and if the NPV is equal to 0, that means the project is giving me exactly what I expected out of it. In that case, I'll have to accept the project. Whereas if I take weighted average cost of capital for calculating NPV, discounting factor, in that case, I should reject it because this is just breaking even, ignoring the non-financial aspects of it. So please understand, what is the discounting rate used for calculating NPV? Based on that, NPV equal to 0 can be accepted or rejected. So you need to know there is a lot of depth in the subject. So you need to figure it out. So moving further. Residual income. Oh, EVA. Sir, this is pain in the back. Like this is a legit painful area for me to understand. Do not worry at it all. Do not worry about it at all, guys. economic value added is actually very, very, very easy once you understand what they are trying to explain you in that concept. Let me tell you something. All the ratios, all the ROI, ROC, all these nonsense things are calculated on book profits or are calculated on the values mentioned in the books of accounts. And books of accounts is full of estimates, assumptions, provisions, prudence concept, going concern, matching concept. You tell me, so many concepts are there, but some of them doesn't really make sense. Sir, prudence says create provisions for anticipated losses. You're telling that I'm worried some of a customer might not pay me in the future, so I'll create a provision now in the books of accounts. Yes, for books of accounts, that is fine. But when I'm doing performance evaluation, this is not something that we lost now. So why should current year performance be impacted because of future expected losses? If something happens in the future really, then that would be that period's loss for performance evaluation, not for financial reporting. Sir, accounts is fine, IFRS is fine. Am I making sense to you guys? Like this provision example, just for you to understand. Let me tell you a different example, sir. Let's say I purchased a machine, and for reporting purpose, we are saying that, sir, we do not want written down value method like percentage calculation, then subtract it, then again on opening balance calculate. So that is very difficult. We'll do SLM. Okay, agreed. Straight line method you do. I'm saying I purchased for 100,000. I'm expecting 10 years, no residual value. 100 divided by 10, 10,000 yearly depreciation. 10. Okay, done. Cut. 10 years, 10,000 depreciation per year. But imagine, we are not talking about financial reporting, sir. We are talking about performance measurement. We are talking about performance evaluation of a company. What if in year 1, I did not really use it at 10%? 10,000 is basically 10% of the assets value, right? Sir, I did not really use 10% worth of the asset in the first year. Actually, I used only 2%. Next year, I used 5%. Next year, I used 20%. I don't know. Some years, your utilization of the assets could be more. Some years, your utilization of assets could be less. But straight line method in books of accounts, same depreciation every year. So, economic value added is basically nothing but taking the book profit and trying to convert that book profit into meaningful returns that the company generated. Actual performance returns, or something that can be used for performance evaluation. Is the concept clear now? What exactly is EVA trying to do? It is trying to pick the flaws in the profit that you calculated as per accounting rules and trying to match it or trying to make it more meaningful or reasonable so that you can use that value as a measure of performance of the company. So that is why we are using the word adjusted value of capital employed at the start of the year into weighted average cost of capital. Can we say adjusting non-cash items? Sir, who said non-cash or actual cash? See, I'm not deducting or I'm not adding back the total depreciation. Utilization of an asset is non-cash transaction only. But depreciation as per books of accounts is not actually utilized, or maybe more than that is utilized. So I'm not looking at books calculation. I would actually take the actual utility or utilization of assets into consideration in case of depreciation as an example. Okay, right. So we take NOPAT. What is NOPAT, sir? Your net operating profit after tax. So this is not your book profit. This is an adjusted profit. And from that, you are subtracting opening balance or basically adjusted capital employed at the beginning of the year minus, into the cost of capital. This will give you what is the minimum return on to break even, and then you calculate actual capital or actual return on the top, actual profit minus cost of capital. So the difference is nothing but economic value added. So isn't this similar to residual income? Yeah, it is similar, but residual income is calculated on books values, whereas EVA is calculated on actual utility related. So EVA is nothing but, I can say, adjusted RI. It is residual income, but instead of taking book values, I take the more reasonable values. But how do we in real life know what the economic depreciation of an asset is? There is no standard that can tell you how to calculate it. But then managers of the business, sir, what do you think managers do in companies? Do you think that they just say, you go and do that, you go and do this? Is that all managers do? No. So managers actually calculate this stuff. They'll be like, okay, this year the asset was used to produce this many units. Over a reasonable basis, the asset is supposed to be used for, let's say, I purchased a machinery manufacturing for manufacturing purpose. So that machinery has a lifetime capacity of 10 lakh units. In a particular year, we have produced 1 lakh units. So the managers would be understanding that, and they'll be like, okay, this year we actually used 10% of the life of the asset, or 10% of the value of the asset. That may or may not be equivalent to the books of accounts depreciations. Machine hours, yeah, agreed. I took number of units, you can take machine hours, meaning a repair could increase the asset's life. Yes. Yes. So all these things may not be truly reflected in your books of accounts, but EVA addresses those things. This is more internal tool. EVA is not actually published to shareholders, sir. There is no standard. Auditors cannot vouch for this. So there is nothing like auditors, IFRS, financial statements. Auditors can say that, yes, the financial statements are presented in a true and fair manner and are representing and are prepared as per the applicable financial reporting framework. But there is no such framework for EVA calculation. So that is why auditors do not express an opinion on EVA. So it is not given to shareholders. This is more an internal tool for performance evaluation. Are we good? Nice. Good. So what adjustments do we do, sir? Please understand, sir. Simple. Use your logic. Look at this notepad. So I'm starting with net operating profit after tax. I mean, that is my end calculation actually. So we'll take the operating profit as per your books of accounts. Take your books of accounts profit. Add the accounting depreciation. Accounting depreciation, you are adding back. And then what we are doing, sir, we are deducting the economic depreciation. So a books of accounts expenditure, estimately calculated expenditure, is added back to the profit, and the actual consumption of that is reduced. Am I making sense? Good. Similarly, look at the next adjustment, sir. Increase in profits is added, increase in provisions is added back. So if your provisions are increasing, that means expenditure will increase. So that will reduce your profit. This is not a current year performance measure. So this is for the future, sometime in the future. So I should not impact my profit by this increase or decrease in provisions. So if you increased the provisions, reverse it back, add it back to the profit. If you decreased the provisions, deduct it from the profit. Similarly, if you have any non-cash expenses like amortization, impairment losses, those are not really performance related. Sir, you might ask me, sir, isn't it impairment is an actual loss only, no, sir, economic loss only? Yes, that will come under economic depreciation. Impairment is included in economic depreciation, my dear friends. Be very careful about it. Okay. So if you have added it back, you will again deduct it below. That's not a big deal. And similarly, advertisement, research and development, employee training. So why should we deduct these expenses? Understand, if you go to your IAS 38 intangible assets, there you say that if you have research and development Research phase should go into expenditure. Development phase, we will again check the PI rate condition, PIRATE conditions will be checked. If PI rate conditions are satisfied, then we will classify it as an intangible asset. So we will split the research and development and then we will record appropriately. Sir, nonsense, oh sir. Remove all that nonsense. Okay. So whatever you are doing it, this advertisement, research and development, employee training, these things will give you benefit over a period of time. These are not for 1 year. In your books of accounts, you might have charged it to profit and loss of 1 year, but that's not 1 year's expenditure. That is for a period of time. So you add back such expenditures which are charged to your profit and loss, and then rather in place of that, you subtract the amortization of that. Means what, sir? You allocate that to each year and then you deduct that amount. Suppose I spent 10 million on advertisement. Okay, this 10 million is not just for 1 year, maybe this is for the next 5 years. So in that case, I add back the 10 million if it is charged to profit and loss, and then I'll deduct only 2 million every year, amortization on that. Sir, your IS 38 intangible asset says research should be charged to P&L, but even that research related benefits also you will get over a period of time. It's not just for 1 year, right? So now you guys tell me, last adjustment, tax paid including lost tax relief on interest and all, whatever taxes you are paying, that should be deducted. Then you will get net operating profit after tax basically. So taxes we are subtracting at the end. That's straightforward adjustment. Now you tell me, sir, what is complication in EVA calculation? Capital employed calculation is acha. Now I explained the left side portion of it. So now you tell me that sir, left side is fine, sir. We are worried only about the right side part of it. Acha. Vivek, this is too clever being. Okay, chalo, no problem. Let's see the capital employed portion also, sir. We'll talk about that also. So what we are doing, we are taking the capital employed at the beginning of the year. Okay, agree, no problem. Then what are we doing? Adjust to reflect replacement cost of the asset. What do you mean by replacement cost, sir? Simple. If right now I have to replace my asset with a new one from the market, not a new one, but similar one basically. If I want to discard this and replace it with a new one, what is the cost I have to pay? So my books of accounts might actually show high value or low value, but I want to adjust the books of accounts value, the capital employed value, to the real market value. Replacement cost pay. Sir, my books of accounts is showing assets for, let's say, $20,000. But actually in the market, the replacement cost of this is only 18,000. So when you are calculating EVA, the denominator, capital employed, sorry, not the denominator, but the deduction, capital employed into weighted average cost of capital. The capital employed, you should only include 18,000, not 20,000. Or if you start with 20,000 minus 2,000, you deduct here. Okay. Similarly, second one, adjust to reflect economic and not accounting depreciation. Sir, already I explained it. Same here. The similar thing you have to adjust on the capital employed portion also, depreciation related. Subtract the economic depreciation. Take the cost of the asset, add the book depreciation back, and then subtract the actual economic depreciation to get the carrying amount of assets. Similarly, if you have any provisions in the current year, add them back to the capital employed. Any non-cash expenses in the current year, in the previous year, add them back. Then add NBV. Net book value of advertising, R&D and employee training at the end of the previous year. So these are basically like in the books of accounts, if you have adjusted for something in the previous periods, you need to make those adjustments. Whatever you have done here, only these adjustments are also adjusted on the capital employed side of it as well. There's no new things that I'm seeing here, but the only thing is whatever we have done here is for 1 year, whereas this is for accumulated over a span of time. So maybe there you might be slightly confused on that. But then let me tell you one thing, sir, if the concept is clear, Even if your calculations go slightly wrong here and there, sir, I did the NOPAT calculation properly, sir, capital employed, I'm confused a little bit. No problem, you will lose hardly what, 1 mark or 2 marks. The rest of the explanation will fetch you all the marks. This is not something that I am saying. This is said by the examiners only. ACCA's examination guidelines only say that. So there is nothing wrong in wrongly calculating a number. Absolutely no big deal. You'll lose maximum, you lose 1 or 2 marks. As long as your interpretation beneath that is perfect, you will get all the marks that you deserve. Okay. Cool. Chalo. Then value-based management. So managing your company on the basis of the value that you are adding to the shareholders, value that you are adding to your customers. So anything that you do, always remember shareholders are the primary focus of the company. So whatever you are doing, that should add value to the shareholders, that should add value to your customers. So you will build goodwill, you will build brand image, then that will increase the sales, that will increase profit, that will increase shareholders' wealth. End of the day, shareholders' value maximization is the primary goal of an every company. Interest of its shareholders is the primary focus. Ultimately, everything that you do should increase the value of a company. The total value of the discounted cash flows. So please understand, how do we value the share price? How do we value a company? You do that in AFM if you understand it. But if you haven't done AFM, no problem. You might have done it in FM. Last May, you have mergers and acquisitions topic, right, in FM. So in that, you do business valuations. There are so many methods. You calculate NPV of the business, then divided by number of shares, you get each share price. Or you can take market price, you can take book price per share, you can take adjusted IRR calculation, something you can do to get the value of the share price. So many methods are there. One of them is DCF technique, discounted cash flows techniques. So there should be one overall metric for the entire organization. It could be EVA or market value added. Sir, market value added means sum of all the years EVA, nothing more than that. Don't do overaction. Market value added means sum of all years EVA. It's just the total, nothing more than that. Value drivers are identified. Instead of cost drivers in ABC, we calculate value drivers. What activities drive the value of the shareholders? What can I do to increase the value of the shareholders? So in implementation of VBM are regular steps. Same steps will be there. What are those? First, develop a strategy. Then set targets for those strategy. Set some operational plans, how to implement that. There should be performance measures and proper rewards for that. Khatam. Design, implement, monitor, review, and reward. Khatam. Nothing is there in this. Advantages and disadvantages. Now coming to transfer pricing. Okay. So transfer pricing related. Do you guys need any break? No? Okay. Cool. Good. No. I do not need any break. I have another meeting scheduled at 7:15. So I'll have to close your session at 7 and I'll have a 10-15 minutes break and then I'll have another meeting with the client. Chill. Let's continue then. So transfer pricing. So what is transfer pricing, sir? You might have multiple divisions in your business and you might need to transfer goods from one business to another business, or you might have to provide services from one division to another division. So in that case, what should be the price for those transfers? How should we fix the price of internal transfers between divisions? So before we set the price, before we set the maximum slab that is the buyer is ready to pay and the minimum price that the seller is ready to accept, before we calculate that, we need to understand transfer price should have certain qualities. What are those, sir? First one, goal congruence means the purpose of transfer pricing should be overall organization's benefit. It should not be for one division. It should be for overall organization. It should be fair for all the divisions, whether it is buying or selling. You should be unbiased and fair. Autonomy for divisions. Divisions should be able to make decisions. Do not fix the transfer price at head office level. Let the divisions fix it for themselves. There should be autonomy in that. Assist bookkeeping. So transfer pricing will help in preparing proper books of accounts. Minimizes the global tax liability. So if you have multiple divisions in different countries, you can use the transfer pricing as a tool to reduce your overall tax liability. And then last one is it considers the spare capacity. Suppose if one division is having more capacity, unutilized capacities that can be used by other divisions. So overall companies, overall efficiencies and effectiveness will improve because of having a appropriate transfer pricing. Okay. Most important things that you need to consider, sir. Yes, these are all fine. I want to go to, these are not covered in this. Okay, cool. I'll just share the chart that Vivek has prepared. Thanks to Vivek. So, new share, Vivek's share. Okay. Please confirm if you guys can see the screen or not, the chart that he has prepared. You're still using that good notes only, no? This looks like a good note one. Yes, nice. Okay. So I'm trying to find out where the full screen button is. Ah, here it is. Okay. So I believe you guys can see the full screen version of it. So transfer pricing, if you see here, why can't I zoom this? Full screen, there is no zoom. Sure. Okay. This is better. Chalo. So each division will have its own accounting books, obviously, and each division would want its profits to be more so that the divisional manager can get higher returns, profit related, performance related bonuses and all. So here he is showing a small example where you have like two divisions in your company and one division is transferring certain goods or services to another division of your company. And what is the prices? So imagine a situation where division A is manufacturing the raw materials and division B is assembling and selling the final product to the end consumer, it seems. Okay, that's an example that he took. Seller is division A and buyer is division B. So the key points that we need to keep in mind: goal congress, fairness, autonomy, bookkeeping, minimizing global tax liability. I have already explained you all that stuff. Okay. Then, what are the general rules for setting the transfer prices? So this is what is our crucial thing. So understand there are different types of situations. First, we'll look at one situation by situation. First situation is where you have perfect market. So what do we mean by a perfect market, sir? Where whatever you produce is consumed by the market. There is a full demand for your product. So you produce it, people are ready to buy it. There is no delay only. So there is deficits in the market actually. There is no surplus quantities in the market. In that case, why would division A, the selling division in this case, why would they sell to division B at lower price, sir? They're like, no matter what we produce, market is ready to buy. I will not sell it to you. I'll sell in the market and I'll make profit. If you need the goods, if it is mandatory for you to get the goods, then okay, I'll sell it to you, but only at the market price. I will not sell you even a single dollar less than the market price. I want my full profit. See, in case of a perfect market, level 1 in fair value markets, like he's connecting with IFRS 13 fair valuation, there will be single price in the market, infinite demand and infinite supply. So there is a plenty of fish in the seas. So basically, no matter how much you supply, there is demand for that. So in that case, the transfer price would be fixed at market price. Means the seller is like, I will sell only at the market price. But if there are any cost savings due to selling within the division, so maybe some packing came in removed, branding can be removed, etc., etc. Like, yeah, this is what the example I gave in my regular class also. If you're selling to a division your company owns, you can save a lot in packaging as they don't have to be attractive, like brand packaging and all that stuff you can remove. So you can save some money. Maybe that price you can reduce because your profit won't be affected because of that. So suppose I am spending $2 on packaging and labeling and all that stuff, branding. Suppose if I'm selling to my own division, I don't need to do all that. So I can save that $2. So I can sell that at less than $2. I am not losing out on anything as a seller. My profit will be exactly the same. Both overall company will be profitable because total company ke liye cost saving is there. As simple as that. That is what goal congruence is all about. Then talking about the second case where the seller is having surplus capacity. Surplus capacity means what? There is not sufficient demand in the market. Even though here he's saying, even if I could sell 6,000 units to the market, I would still have or can make 4,000 units ready for sale when there's absolutely no demand. Okay, see, oh, I'm reading it further. Okay, I could make 10,000 units as my fixed cost has already been paid for, but the market has a demand for only 6,000 units. So the surplus 4,000 units, even if I produce also, it is useless for me because there is no demand. So the seller is having surplus capacity. So what are we supposed to do in this case? So basically, there is no demand for your product. So you cannot demand higher price from your buyer. So in that case, minimum price that the seller can go down to, but I would make an additional note point here, Vivek. I believe you can make that now also. Minimum price seller can go down to for the surplus capacity, not for the total capacity. Only for the surplus capacity. Here, there is demand for 6,000 in the market. If suppose the buyer is asking, I want 5,000 units, the seller will be like, see, I can sell total 6,000 in the market. I have a maximum capacity of 10,000. So if I sell 6,000 in the market, I'll have only 4,000 surplus capacity left. That 4,000 I can give it to you at a discounted price, but total 5,000 I cannot give you at discounted price. That would mean I'll lose out what profit I can make by selling in the market. Is that making sense or is that confusing, sir? Right. So I can sell it at a market price, the 1,000 units, but you are asking me total 5,000. So 1,000 I will sell you at market price. Remaining 4,000 I can sell you at a discounted price because that is my surplus capacity. So what is that discounted price, sir? See, in no circumstances I can go below my marginal cost. Sir, why can't I go below marginal cost? Because that is the variable cost. That is minimum cost I incurred on the production itself. Fixed cost I can ignore because anyways, if you do not buy from me, I incur those fixed costs. So I will not try to recover fixed cost from you. But minimum I can agree is market marginal cost minus any additional saving. That additional saving will remain the same. Let's not worry about additional saving related aspect. So the minimum that I can accept is marginal cost that I have to recover. So marginal cost will work only for surplus capacity. But if you do not have surplus, market price will be taken again. Remember, the fixed cost has been paid for. He at least wants to break even. We could argue he doesn't have to produce those extra units, but remember the concept of goal congruence. Nice. He can say, sir, if I go down to marginal cost, I will not make any profit, na sir. Yes, but your buying division may actually make profit, which is good for overall company, and also recovery of fixed cost is a good concept, right? So when you are utilizing that surplus capacity, your fixed costs are being recovered, which is good for you. Next, what's the maximum price that the buyer can go up to? He can either go up to a maximum of market price. Buying division will not be fool enough to buy it higher than market price. So they'll be like, we'll pay only what is the market price maximum. If it is beyond that, I'll buy from the market. Why would I buy from you? Or final sale price minus incremental marginal cost. What do we mean by final sale price minus incremental marginal cost? So it means basically, suppose in this example that we started with, division A is producing the raw material and division B is assembling and selling it. So division B also incurs further cost, purchased from A, assembling, and then packaging and selling it to the final good to the product, to the end consumer. So division B is buying raw materials from A to make a product and obviously sells it, hopefully to make a profit. So if the final sale price is 35 and the incremental marginal cost, the production of that, like basically the assembling cost is $15. So 35 minus 15. So even if they have to break even, the maximum price they can pay for raw material is only $20. Right? I'll not read the rest of the line. Censor cut ho jayega. No props, no props. Right? Next. Last case, if the seller does not have any surplus capacity, sir, market is demanding 10,000 units. I am producing only 8,000 units. There is no problem. I mean, I'm not even able to meet the market demand only. So why would I sell to my other divisions? Even if I sell, why would I accept anything less than the market price? Okay. So minimum price that the seller can go down to. I could only make 10,000 units. Market has demand for either equal to or more than. So I could potentially sell all my units to the market, usually external market. Yes. Marginal cost plus lost consideration. So this is basically, technically, this total is equal to market price. Cost plus lost consideration is market price only. Lost consideration is means what, sir? What I lost by selling it to you. This is total equal to market price. Simple. Remember, he could have sold it to the market which has greater demand for some fat profit. Yes. And maximum price the buyer can go up to, again the same thing, sir. There is no change in that. Either he'll be ready to pay you market price, or he'll be ready to pay you whatever he's selling minus whatever additional cost he's incurring. That's the case where he breaks even. So he doesn't want to run into a loss, so he would be interested to pay anything more than that. Chalo. So my dear friends, that is your transfer pricing. Tell me, what is the difficulty in transfer pricing now? There's absolutely no complication involved at this point, I believe. Is there anyone who is still having problem in this area? Transfer pricing. I hope they ask questions in transfer pricing. Nice. Okay. Clear now. Okay. Let me just scroll down and see. This is chapter 8, right? No, 9.6 transfer pricing. So see, this is my class notes and my actual handwritten notes. Vivek has taken this and he made it into that nice looking chart. This is what I told you. I do not pay attention to how my notes are looking or how it is. It's basically what I share with my students and they can make it more nice. See, yeah, this is the one that I used in my class. Transfer pricing, perfect market, seller has surplus, seller does not have surplus, minimum price, maximum price, market price, final sale price minus incremental. Yeah, this is the same thing that he has taken and he made it look more beautiful, I believe. 9, okay. Chalo. Cool. So let's move further. Let me just share that back to our notes, then back to our pocket notes. Chill. So we are almost all down to 6. So let's get it done faster. Chill. So that is the general rule regarding transfer pricing. And then there is issue of this dual pricing. So dual pricing and two-part tariffs. What are these two? So two-part tariff is basically marginal cost plus periodical lump sum. What do you mean by marginal cost plus periodical lump sum, sir? Division A is selling to Division B. Division B needs to pay to Division A. So Division B is telling that, but remember one thing, we'll pay you marginal cost every time, only the marginal cost. So then how will Division A recover fixed cost? Don't worry. At the end of each year or at the end of periodically, quarterly, half yearly, whatever, we will pay you lump sum amount for recovering your fixed cost. So periodically marginal cost will be paid. In one lump sum, we'll pay you fixed cost also for your recovery so that your division also makes some profit. So that is called two-part tariff. And then there is dual pricing. Buying division will record at lower price. Selling division will record at fair price, market prices. So then there will be difference in overall records, sir. Head office will do adjustment entries. Please understand, sir. The head office will record period end adjustments. So buying division will record at lesser price. Selling division will record at higher price. When doing the consolidated report, the head office will do a periodical adjustment for those differences. That is what is dual pricing is all about, to keep both the entities happy, buying division and the selling division. Then talking about international issues, sir, please understand there are some taxes that you need to pay. We call it as remittance taxes. For example, if a foreign company is setting up a branch in India and if they are taking away all the profits that are earned in India, it would not help in growth for Indian economy. they will be utilizing our resources and their country will be growing. But we want our country to grow. So we'll be like, you have to keep the money that is earned in India. You should not take it back. But if you want to take it back, then you have to pay taxes on that. Sir, but didn't we already pay taxes on the profits that the company made? That is fine. That is income tax. You have to pay tax at the time of remittance again. Double taxation. So these kind of transfer pricing, international transfers related rules and regulations would be there. So you have to consider all that stuff, and then also consider that there will be different tax rates in different countries. So it would be better if you transfer at higher price if your country is having higher tax rates. So for example, we are producing a product for $100. Suppose in country A, the tax rate is 30%. In country B, tax rate is 20% only. So this product produced at 100 is transferred to division B and then sold to the customer at 150. End customer we are selling at 150. Now you tell me at what price should I transfer to my division B? Should I transfer it as 120 or 130 or 150 or 100? What makes more sense? See, here the tax rate is 30%. So if I make a profit in division A, I'll have to pay 30% to the government. But if I make the profit in division B, I'll have to pay only 20%. So if I transfer at 100 here, so buying price is 100, selling price is 150, $50 profit into 20% will pay only $10 to the government. Suppose if I transfer at 120 to division B, $20 will be booked by division A, on which 30% tax means $6 will be paid by division A, and division B will make a profit of $30, 120, 150, $30, on which they'll pay 20%, which is again $6. So sorry, $6. So 6 plus 6, total $12 we'll have to pay. But if we transfer at 100, we'll pay only $10. So like this, based on the tax rates in different countries, we'll have to determine the transfer pricing when you are doing international transfer prices. Are we good? Right. And one more thing, sir. There will be some transfer pricing rules as well. You know, division A can say that country in which division A is located, they'll say that, acha, you're transferring at cost to cost. Okay? You're producing for 100 and you're selling for 100. Good. What is the profit? Why are you using Indian resources or whatever that country is? Why are you using those resources without having any profit? You're paying all the taxes in that country. How will our country grow? So they're like, you should keep at least a profit of 10%. They might put such a condition. These are called transfer pricing rules, or else we can call it as arm's length pricing. So there should be a fair arm's length price. Whatever you are selling in the market, sell to your own divisions also at the same price, or at least a reasonable price. Do not sell it cost to cost so that our country will not grow. Such kind of rules will be there. Okay. So what are the total number of chapters? 12, right? 12. So we are having 3 more to do in the last 1 hour. So let's get our horses running. Let's keep our spirit high. Let's go, sir. We are almost all on the 10th one. So, oh my God, this is the most easiest chapter in your entire syllabus, isn't it? Not for profit. Companies which are not running for profit. This is the topic where you'll be like, yeah, they're not doing it for money. So financial performance measures does not make any sense. If you go to a trust or a cooperative society or any kind of charitable trust, so they are not doing it for money. So how do we evaluate the performance of that? I cannot say GP margin, NP margin, ROCE, asset turnover. They'll slap you on the head. They'll be like, we are using donations. We are not making sales. We are doing donations. So how can you ask us what is the turnover growth? We are not at all working for profit. How can you ask us what is the GP margin? So they'll be like, for not-for-profit entities, their performance is evaluated on the basis of 3 E's: economy, efficiency, and effectiveness. Very quickly, one word answer. What is economy? One word answer. One word answer, sir. What is economy? Money. Very good. Or if I expand it a little bit. So you said low cost. I said one word. So I wrote money over there. That's good. Cost. Yes. If I had to explain it properly, it would be reduce cost without compromising on quality. Simple. That is economy for you. Next one. What is efficiency, sir? One word. Utility of resources. Very good. So performance is effectiveness. Efficiency talks about utilization of resources. Basically, your input, how much input you are taking to get the output. Are you using your inputs properly or not? Human resources, capital, or material, labor, whatever. Are you efficiently using your inputs? Efficiency is always about inputs, whereas effectiveness is about output. This is where targets are met or not, end goals are satisfied or not. Effectiveness talks about the outcome. Did we reach the thing that we wanted at the beginning of the topic? That is what is called as effectiveness. So economy talks about money, low cost, better quality. Efficiency talks about proper utilization of the resources in your organization. And effectiveness talks about meeting the targets that we set or reaching the outputs that we wanted. That is called effectiveness. So that's the concept of value for money. Done. Then concept of league tables. Sir, what do we mean by league tables? Like we have this IPL tables and all, right? You have a match starting at 7:30 and Vivek is very much interested about that match, it seems. But anyways, so you have IPL will have these tables, or even ICC ratings will be there. What is the ODI number 1 country, number 2 country, number 3, like that. They give some rankings to different countries and all. So here league tables basically do the same thing, sir. Actually, there is a league table for match after class. Yeah, good. Sir, unfortunate for me, I have a client meeting after the class. I can't help it. But anyways, so league tables are for this not-for-profit organization. Their ranking tables are called league tables. It could be for educational institutions, number 1 school, number 2 school, number 3 school, so that. So how do they do that? Those league tables are prepared on the basis of the 3 E's: economy, efficiency, and effectiveness. Katam, that is the end of this chapter for you. Private sector, public sector, problems, solutions. We use value for money framework. We do not use any ratios and all that nonsense. So there could be conflict of interest because there are multiple and diverse objectives. So yes, obviously a trust can have multiple objectives. So you need to know the priorities. You need to make certain compromises and then use value for money and spend more money on those aspects where you have all the 3 E's supporting. Right? And then you have impact of politics. Sometimes politicians may enter into your areas and then they might cause some difficulties. So you should be working well with the politicians and create good, healthy relationships and all that nonsense. So NFP is value for money, economy, efficiency, effectiveness. 4th E, equity is also included sometimes, means not being biased, providing equitable facilities to everyone. Then you have benchmarking. Already we have discussed league tables, targets, all that nonsense. Done with another chapter. Moving on to the last 2 chapters of your syllabus, sir. One is non-financial performance measures, and then they removed this thing. Now they removed corporate failure. So what's the other one that is left in your syllabus? Oh, quality. Okay, these strategies and all. Okay, good. So the last 2 most crucial topics of your entire syllabus. So we have 1 hour for these 2 chapters, which is very good. So let's get into these things. So the non-financial performance measures, sir, you know what they are, like which are not related to the financial aspects of it, like quality of the product, satisfaction of the customer, employee satisfaction, long-term brand image generation of the company, reviews that we receive from the customers, all that nonsense comes, which are not measurable in terms of money. They're covered under non-financial performance indicator. Simple question that I ask my students in my regular APM class. If I ask you, tell me a good restaurant. Please focus on KPS. I always struggle to. Okay, good. No problem. If I ask you, recommend me a good restaurant in Hyderabad, what will be your answer? You will tell, so go to Bawachi or go to this, that, or XYZ restaurant. I don't mind, whatever it is. But if I ask you, on what basis did you tell me that this particular restaurant is good? What will be your answer, sir? Will it be based on like, so they have high GP ratio, they have high NP ratio, they have very good operating margin? Do you say that? You'll be like, sir, no, the food quality is good over there. Taste of food is good over there. The pricing is comfortable range pay. It's neither too cheap nor too costly. It's acceptable. It deserves that pricing. It fits that quality and quantity that they are serving. The taste that they are offering. The price is reasonable. So you might give me these things. So none of these are related to financial. And the waitresses sometimes. Sir, Hyderabad, you will not find waitresses. Very, very rare. And areas where the food is actually good. God, those people are messed up at another level. You go to Bawarchi, for example, the food is good over there, sir. Very good over there. The prices are so reasonable. I'm not talking about red Bawarchi, green Bawarchi, and all these fake ones. The original one, which was in RTC Crossroads. If you really go there, the food is good. If you're a non-vegetarian, the food is really good. But then the customer, the servers or the waiters, they are so rude. I mean, with all due respect, the problem is they do not have sufficient time. At least 1,000 plates of biryani is served on a regular basis in Bawarchi. 1,000 a day. Yep, you do not need to note it, sir. When you come to Hyderabad, you can ping me and we can all go out. You do not need to note them. They sometimes ruin the experience, yes, but you know, they do not even give a menu these days. Bawarchi will not even give a menu. They'll be like, just these are what are available, so you pick one. They'll just tell you by mouth. They'll be like, 1, 2, 3, 4, 5 items are available. Tell me what you want. If you insist and you're like, no, give me the menu card, then they'll give a weird expression. They'll take a couple of minutes after making you feel embarrassed for living on the earth. And then they'll give you a menu card. Anyways, coming back. So yeah, it's not their problem also. You are still here. Agree with that. Anyways, coming back, sir. Do not get me started on food. I love food. So do not get me. So if you ever want something from me, just offer me food. You will get your answer. You'll get your thing. So anyways, moving further. So non-financial performance measures. So when you ask someone about recommending a restaurant or anything like that, basically a service, your primary concern is something that has nothing to do with money. Your primary concerns would be, suppose if somebody asks you, I'm looking for lectures for APM, where should I enroll? So your answer would depend on the quality of the lecture that the faculty is delivering, the resources that they are giving you, the support that they are giving you, the exam support that they are having, the revision sessions that they are conducting, or whatever. None of these are really financial. The last thing that you would look is, how much are you looking to pay? This is what he does. This is what they provide. This is what they charge. Is it reasonable for you? If not, you have another alternative. So those non-financial performances are crucial for a company's performance evaluation. So there are different models for you to consider. But before that, what are the problems with financial measures? They are short-term in nature. They focus on internal aspects. They do not give you the complete picture. They're backward looking. They're all historical. They can be easily manipulated. I already spoke to you about all of this. So that is where non-financial performance measures come into the picture. They are more like management of human resources, your customers, your employees, all these people. Product and service should have proper quality. Brand awareness should be there. Your company profile should be visible to the customers. That is my biggest problem, sir. Trust me when I say this. Brand awareness, company profile, and visibility is worst when it comes to my lectures. Because fortunately or unfortunately, I have been teaching since 2016. So it's been 7 years, 6 years, 6.5, whatever it is. And till date, the amount of money I spent on marketing, branding, advertisement, whatever you call it, promotionals, whatever you call it, is absolutely zero. Till date, I have spent zero on marketing, advertisement, etc. Nothing, absolutely nothing. Not even an Instagram ad. My Instagram, our companies, our academy's Instagram page looks like crap. We are very regular. People don't even know we exist. I did not even ask my students who have been with me for so many papers. Vivek has been with me for 3 papers, I guess, since he got exemptions and all. But there are students who started their ACCA with me, completed their ACCA, got placements and are settled. Still, they are not even following my page on Instagram because they do not even worry about it. I do not even talk to them about it. So yeah, I am very bad with marketing or promotion, brand image and all. So non-financially, our performance is a little less in that area. We might need to improve. If in case you guys are good at marketing or if you guys are good at social media and if you are ready to do it for free for me, then yes, we can get into that. But I'm very bad at that stuff. Chalo, coming back. So we have different methods for doing this non-financial performance evaluation. The first one is balanced scorecard. One of the most important one. Sir, when I gave my CSCA examination, that is certified in strategic analysis and competitive advantage. Yes. So certified in strategic analysis and competitive advantage. So that is an examination for top level managers basically. It is provided by IMA, Institute of Management Accountants of US, and it's been ages since I did that. So when I did that CSCA examination, I still remember the main purpose or the core reasonology of that exam. For example, you are doing ACCA, you are all charters, you are more into financial reporting and audit. CFA students are there, they are more into financial management. CIA students will be there, certified internal auditors. So they are more into internal audit. So everybody will have that crux, right? Like a core concept or a core topic. So for CSCA, that core is basically corporate strategies. How do you make companies better? How do they make good decisions? It's all about how do we compete in the market. It's all corporate strategies, basically. So when I gave that exam, I still remember a question has been from balanced scorecard. I watched your SBR free YouTube videos in 2020 and I passed it in one go. Since then, I'm using word of mouth to recommend others to watch your revision and marathon classes. Thank you, Kiran. Thank you. I'll keep it at that. So balanced scorecard. You know, when you say that, the one thing that comes to my mind is, okay, you are recommending everybody to watch revision marathon classes, but why shouldn't they enroll for full lectures with me? But good. See, if the revision sessions are sufficient to pass an exam, imagine what would be the value addition you will get in the full lectures. If you can learn so much in 6 hours, imagine what I can do in 35, 40, 60 hours. Audit is 38 hours. APM is 45, 50 hours, I believe. I'm not sure how much it is. 45 hours, it seems. Vivek is saying 45 hours. So imagine 6 hours, if you can learn this much, how much will we teach in 45, 50 hours? Disappointment from other coaching institutes and no time left. Agree, sir. Sir, just for that reason, I'm telling you, I'm not promoting or anything. Please understand that. If you know any students who are actually facing problem because of getting enrolled with any other institute, they can contact me. Whatever fees they have paid in the other academies, if that is more than our coaching fee, we will provide the classes for free for them. We'll only take reasonable charges to recover our cost, you know, server cost and all. At least 50% discount, I will promise. At least 50% discount on my classes. And if the price that they paid is less than my charging, my fees, which is does not happen. I charge very less. If anybody is charging less than that, and if they are not satisfied over there, they can get to us. Minimum 50% discount will be given to students who have already paid coaching fees somewhere else. Or if they have already given the exam with self-preparation and they could not clear, they will also get 50% discount on our prices. That is damn sure. I'm giving it on the record. And so yeah, if you see anybody who are facing problems by enrolling with some other institutes, touch wood, I mean, praying to God, no student should face any such problems and all. So if at all any such things are there, let me know, sir. Bring it to my notice. I'll try to provide as much benefit as possible to the students. Sir, I make very decent money from my salary. Okay, I also work with a US company as a finance controller, and I make damn good money over there. I mean, not as much as engineers and software people are making, but I make reasonable enough money to meet my expenses. So this is my passion thing. I want to serve the student community. So it's not for commercial reasons. So if there is anything that I could do for the benefit of the students, I'll be ready to do that. So anyways, so how many hours for AFM? Oh God, AFM is such a big thing. So AFM, we have done a different kind of thing where we did our regular full classes, entire BPP, plus at the end of BPP, there is additional learning content for you guys where concepts are taught which are not for exam. Even those things are also covered. So AFM, I'm just scrolling through that. It's 52 hours of lectures and 16 GB of data. So we give this thing with to all my students. There is this index file that is given for all the subjects. Even if you are not enrolled also, this will be shared for you. So each topic, each chapter, each topic, how much duration is there? There is no hiding. It will not be like false promises being made or anything like that. They exactly tell you what is the duration of the lectures, and that will be what you will see in the lectures also. Actually, sometimes more videos could be there than this. I'll be like, okay, do you know what this topic is covered in PM? So I'll add that here also. If you have got exemption in F5, you can refer that in this video. So that kind of additions will be there. If APM is there, you will see PM plus APM in that, like that. 57. Oh, Vivek remembers the hours also. God bless you, Vivek. Okay, good. Chalo, let's not do marketing, sir. I'm not worried about it. I'm just, since the point came up, I'm saying that SBR has a lot of FR. Yeah. Sir, FR, whoever has enrolled for SBR, I give FR lectures for them for free, no extra charge. If somebody enrolled for AFM, FM lectures are included in AFM, SBR, FR, APM, PM, we do that. It's always there. I do not trust that students, I mean, a lot of my students get exemption in the skills level papers. So those exemptions need to be addressed. I believe in full conceptual clarity. Just give me a second. There should not be gaps in the knowledge. That is what I believe in. Chalo, bahut zyada ho gaya. I believe this is the first time ever I spoke about my academy to the students this much. I don't know. Anyways, coming back. So the first thing is balanced scorecard. I was talking to you guys about my CSCA exam. So when I gave my CSCA exam, I still remember there was a case study for 100 marks. The thing that you have in your SBL, 100-mark case study. We have 5 such case studies. Not 5. No, sorry, not 5. 2 case studies and 100 objective questions. Yeah. So 2 case studies used to be there. So when I gave that, I still remember there was 100-mark case study and balanced scorecard was tested in that. That entire case study was how to use balanced scorecard to evaluate the overall performance of the company. And unlike in your APM, they'll test you hardly 4 or 5 areas. They'll give you 4 in financial, 4 in customer, maybe something like that. For us, it was a 5-page or 6-page document, and we have to figure out where the bits and pieces are and then pick them and throw into the respective 4 categories and then do a complete analysis of that. It was more comprehensive. You get the knowledge, right? Like I don't know if I'm still the only one, but I'm the first person to qualify that CSCA from both Andhra and Telangana states. So you can understand the levels of difficulty and other aspects. Only very few people enroll for that in the first place. So it's whatever. Even at that level also, balanced scorecard was tested. That is what I want you to understand. So when balanced scorecard is basically a very comprehensive performance utility tool, performance measurement and management tool. So in balanced scorecard, what we do is we evaluate the company's performance from 4 different areas. So normally we just evaluate on one factor, which is financial reasons. So ROCE, ROE, liquidity ratios, gearing ratios, EPS ratio, PE multiple, we'll do all that stuff on financial area. But balanced scorecard, we will evaluate from a more comprehensive, more holistic picture. So what are the 4 factors that we evaluate, sir? From financial perspective, how is it looking to our shareholders? From customer perspective, are customers really satisfied with our product? Then innovative and learning perspective, are our employees continued to grow? Okay, so innovative and learning, are we able to, sorry, not employees as such, innovative and learning means, are we creating more value to our customers? Are we adding, are we developing on our existing product, or are we still stuck with the same old product? Are we adding more features to our product or not? So are we innovating as a company? Are we moving forward as a company? Are we learning from our past? And the last one is internal business perspective. Internally, are we improving our efficiencies or not? Are the employees happy with our company? What are the areas at which we can improve more? So in 4 different areas, one from financial aspect, one from the customer's perspective, what are they expecting? Are we able to reach their expectations? Then innovative and learning, are we moving forward in our overall performance? Is the company growing forward? Then internally, are the employees happy with the company? Are the efficiencies, operational performances are going better or not? Now, sir, Vivek is asking me KPIs, sir, KPI. Okay, let's do that. See, within each perspective, the organization should identify the CSFs and establish appropriate KPIs. That is the requirement for your examination. So he is justified in asking me to tell sir KPIs on each of these things. We know the concept, but we want you to help us in identifying the KPIs. So help us with that. Okay, let's do that. Financial, all the ratios. Customer perspective. Okay, understand. So you tell me, customer, as a customer, what do you expect from the company? Good quality. So what could be the KPI for good quality? Reviews, ratings, agree. Next, if things go wrong, how can we identify that? If a product is bad in terms of quality, what would you do as a customer? You would either raise a complaint or you will return the product. Exactly. You are telling all the answers, sir. Those are your KPIs, my dear friend. Aur kya chahiye aapko? Either number of complaints received or number of returns that we are getting. That would be a KPI to measure the quality of the product, customer satisfaction of the product. Reviews and ratings is another KPI for customer perspective. Another KPI I'll tell you, number of repeat customers. Another KPI I'll tell you for customer perspective. You may note it down, sir. If you guys are not noting it down, please note it down if you need. Another KPI for customer perspective, turnover from repeated customers. All of these are what? These are nothing but customer perspective related KPIs. Do you agree? Good. Moving on. Innovation and learning perspective. Number of new products launched. Revenue from new products. Number of new customers attained in a particular period. Changes made to the existing products. Increase in the number of goods due to updates. Like for example, 1 plus is there. 1 plus 1 or 2 or 3, 4 or 5 or 6 or 7, 8, 9 or 10. 10 iterations they have passed through. Samsung Galaxy Note, 10 iterations they have completed and directly they jumped to Note 20. And then they are like, no, we are not producing Note anymore. We want to merge Note series and S series. Whatever, that's their personal decisions, sir. Let's not worry about it. But yeah, so innovation and learning, how many new products are you launching? How many patents have you filed for? How many copyrights have you taken in the new way? What is the revenue from those additional products that you're producing? That is all innovative and learning related KPIs. Then internal business perspective, reviews from the employees, your employee turnaround ratio, your efficiency ratios, input output ratios, number of training hours given to the employees. Agree. All of these are what? KPIs for internal business perspectives. What say, Vivek? Are you comfortable now or are you still confused? Like, sir, these are all I know, but then at the time of examination, so that comes with practice.
Yes. No, I was just thinking about the hours of training and development. Isn't it more of an innovation and learning perspective than
learning? Yes. See, it can be included in learning part of it, or it can be included in internal business. So if that is employees are getting trained on how to improve the efficiency of the production process, that can come into internal business perspective. If they are getting trained on how to make the sale to the customer, that can come into learning perspective. It's fine. But the KPI is more important, whether it is categorized in innovation and learning or in internal, it doesn't matter much.
Right.
Okay, good. Sure. So that is about your balanced scorecard. Advantages and disadvantages is left for you. Then, sir, implementing the balanced scorecard, what are the steps? Again, the same steps will be there no matter what strategy or methodology. Make the strategy explicit, make it clear, planning stage, choose the measures, define and refine. So define the KPIs, same as VBM, yes, define the KPMs and then make them clear, then deal with the people involved in that. So monitoring and reviewing everything. So the same phases will be there. So no matter what strategy you take, the same phases will be there. And moving on, so next we have Fitzgerald and Moon's building block model. So you have 3 different blocks. The worst thing about APM's building block model, I do not like the way APM teaches building block model, unfortunately. So I'm being honest here. I do not like the way it is taught. The problem is, out of this building block model is given as a performance measurement tool for you. Agree? So you can see it's a performance measurement system, but only the first part really talks about something. The remaining 2 just talks about the qualities that should be there. It doesn't really talk about performance measurement much, if you see really. So let's see. Let's just go into the depth. Then again, I'll come back to this discussion. So performance, your building block model has 3 blocks. So first one, dimensions, basically the areas where you are measuring the performance. Then standards, they just talk about the standards is basically the targets that you set for them, and rewards is what is the reward you give them when the targets are met. So first you create the areas which are being evaluated. Then for those areas, we set the targets. And then when the targets are met, we give the rewards. So I'll just write it down here. Dimensions are the areas or criteria, I can call it as. Criteria for evaluation. Standards are the targets that we keep for them. And rewards is reward directly. There's nothing really explained. So if you see really, performance measurement is done only in the first phase. Remaining 2, if you see, look at this building block model, they say standards. When you set the standard, they do not talk about how to set the standards. They are never talking about how to set the standards and all. They're saying that when the standards are set, you have to make sure that the standard should be ownership, achievability, fairness. Okay, that is fine. Those are just characteristics. Yeah, they're just features. Yes, correct. So ownership means whatever target you set, the employees should own them. They should accept and work towards them. They should be achievable for the employee. They should be fair towards all the employees. Fine, done. That's all. That's all you want to talk about standards. How to set a standard, how to set a target. There could have been practical examples on that. You could have given a case study on that. No, this is what they want to. Okay, fine. Then similarly, reward. When you are giving rewards, they should be clear. Smart objectives should be there. Reward should be given only on controllable factors. Reward should be desirable. People should motivate them. Okay, fine. That's all you want to talk about. Nothing more than that. Cool. We'll ignore it at that phase. Then when we talk about dimensions. So in dimensions, our major focus is on downstream and upstream. So you have 2 downstream and 4 upstream things. So what are those things, sir? Downstream is basically financial performance and competitiveness. So financial performance, KPIs, you know, hundreds of KPIs for financial performance. Competitiveness, you guys tell me what is how this gets tested on the test, by the way. No, these are not really tested much, not really tested much, building block. The reason is basically this only, na? What will they test you? They are only telling you standards should be ownership, achievable and fair. What will they test you on that? Anyways, so competitiveness is there. Market share, very good, agreed. Apart from that, number of products in your portfolio compared to number of products in your competitors' portfolio. Rankings in the market. Where is your product ranked? All that, market share, etc., etc. Agree. So all of those can be competitiveness. Then quality of service. Already we discussed now, quality, reviews, ratings, returns, repairs, complaints, etc., etc. Flexibility. Number of changes that you are able to make to the product, time taken for changing a product, or if suppose there is a customizable job, what is the time taken for that? Do you agree or not? All that nonsense. Resource utilization, all your efficiency related ratios will be taken, input output ratio and all. What does changing a product mean? Okay, so for example, right now you guys asked me, sir, usually you teach APM in 35 hours or 40 hours or 45 or whatever it is. Can you teach us APM in 6 hours? I'm doing that for you now. I am modifying my delivery of the service in such a manner that it is as requested by the consumer. That is called changing the product or modifying the product. In this case, it's a service in the example that I have taken. That's why it applies only for the service industry. Not necessarily enough. Products also you can do that. So you get all these customized mugs, customized printing t-shirts. Aren't you getting all that? Doesn't that talk about flexibility? Suppose, see, I asked for a diary, your regular yearly diary that we get. So if the company is able to get me a diary, I ask them, sir, can I get some motivational quote at the bottom of each page? If you get that, that's flexibility. Can I get a diary with my picture on that or with my family picture on that? Flexibility. Products can also be customized, isn't it? Tailor-made products. Yeah, I agree, Kiran. And then it's service based, and that's what Kaplan has added on its disadvantages. I mean, it's true. Initially, the building block model was more oriented towards service sectors, but that doesn't mean it should be only for service sectors. See, it is less suitable for non-service sectors. That's what I said. Less suitable, but it's not, doesn't mean product-oriented companies cannot use building block node, can be used. Even though it was initially focused more on service sector. And then innovation is also there. So innovation means how many new products you are launching and all that. We already learned it in building block. So it's the same thing. Can be stringent. It's not Kaplan. Sorry, I have to say it here. It's not Kaplan. It's there with building block as a model only. Even if you see DPP also, they use the same explanation. F&M building block was initially towards service sector, so it's quoted as a disadvantage. Okay, the last one is performance pyramid. So you only have 3 models in non-financial performance measures, right? Performance pyramid. Yeah, the last one is performance pyramid. So understand one thing, sir. This chart will be given to you in the exam if they test performance pyramid. Do not waste time on by-hearting this chart. Not required. They'll give you in the exam if they are testing it. Okay, so don't try to spend too much time, too much money, too much time on learning this performance pyramid or by hearting this performance pyramid. So one thing that I want you to observe in performance pyramid is what, sir? Objectives are moving from top level to bottom level. The measures come from bottom level to top level. So objectives means what? Goals, targets, standards, whatever. They are set from first. Corporate vision will be there. The overall future goals or future aspects or future plans of the company. And those can be split into 2 parts, financial and market decisions. So market oriented is basically at a division level or SBU level, right? Each market is usually a separate division. And then the market targets like your market share, market growth, etc. They depend upon the customer satisfaction and the flexibility of your product. So you can capture more market share if more customers are satisfied. You can capture more market share if you can flexibly make your product. Shouldn't flexibility in level 4, the same way it's upward in, I do not get that. Shouldn't flexibility be in level 4, the same way it's upward in the building block model?
The thing is, I was thinking if flexibility is something that the managers and the employees can do and sort of change, shouldn't it be?
Let me complete this. You will understand why it is in level 3.
Sure. Yeah.
Just give me 2 minutes. It will be done. So just understand this, sir. Actually, when you do this chart specification, you will get to understand it better. So customer satisfaction is there. How can we achieve customer satisfaction, sir? By having proper quality and by having proper delivery. By these 2, you can achieve customer satisfaction. Qualitative product delivered at the right time at the right place. Then customer will be satisfied. Similarly, you can have more flexibility if you can change the delivery times or if you can change the cycle times. Means, can you produce faster? Can you produce slower? Can you deliver it to me in a different mode? Can you deliver it to me faster? Instead of delivering through a fixed channel, can you deliver it to a different channel or with a different packaging? Isn't that what the flexibility that the customer is expecting? So didn't my customers ask me this? My customers, I hate to call it that. My students, the flexibility that the students asked me is, sir, your lectures, we can only, if you're taking it live, we can only access it at one point of time. If I'm in travel or if I'm at office, if I'm at a meeting, I'm missing the lectures. What can I do? I need flexibility with the time in which I can attend your lecture. So we went with recorded. So that's a flexibility that I'm able to provide to my student. So flexibility can be achieved by changing the delivery and cycle time. So delivery and cycle time is in the hands of departments. So that flexibility will be operational unit. Yes. Okay. So that is how this chart is there. That's what. If you just look at these words individually, it doesn't make sense. But the moment you understand that it is basically branched into two parts, which are in the next level, it makes more sense. Similarly, how can I increase the productivity, sir? By reducing the cycle time and by reducing the wastage, we can enhance our productivity. And if we are having more flexibility and more productivity, ultimately our financially, our sales will be more in number. Financially, we will be more profitable. That is what performance pyramid is all about, if you understand really. At each stage, the next two, the branched two will be coming as a reason of explanation for the upper one. I believe now that it's all clear. And next one, quality and delivery are effectiveness. The end user will determine whether your product is qualitative or not, and whether your deliveries are suitable or not. And cycle time and wastage is internal efficiency. Sir, be very careful. That's what I told you. Effectiveness talks about your output. Efficiency talks about your inputs. Now this you can easily understand that. See here. Delivery and quality are end result oriented. Whether you are able to provide quality, whether you are able to deliver it on time. That's end result, output, effectiveness. Cycle time is internal, wastage is internal, so efficiency is used. All the bits and pieces that you learn in different areas needs to be cleared out, needs to be branched with each other and connecting the dots. And then it will solidify your entire knowledge. Right? Good. Sure. So that brings us to the end of another chapter, the last chapter in your syllabus. I have 30 minutes to cover this chapter, which are lovely topics. But unfortunately, sir, I hate saying this. I have been saying this since last 2-3 years. ACCA, this is a general, very genuine request from my side to the ACCA exam paper setter. Please test more topics from chapter number 12 of Kaplan. Please test from Six Sigma, Kaizen costing, total quality management, just in time, lean production. Test more. Give more practical examples to the students. Please request, genuine request. So these are such lovely concepts that are left at a theoretical level for you guys. Exactly. You will not see questions on these topics in the examination. So the reason being, Six Sigma is one topic from one chapter in your syllabus. Six Sigma by its own has 3 or 4 levels. I don't even remember at this point. White belt, black belt. Black belt is the highest one and white belt is the lowest one. They have yellow belt and green belt also, if I remember. Like 4 levels of qualifications in single strategy that you are learning in one single topic, one single chapter. This one topic has 4 levels, sir. Now you understand the depth involved in Six Sigma. All you guys are taught in APM paper is Six Sigma means DMA IC or DMA DV. That's all, sir. Define, measure, analyze, blah, 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 blah. Monitor and DMA DV. Define, measure, analyze, design and monitor, I guess. Something, whatever. So very rare, very basic level explanation is given to you guys. But if you really understand these things, they can have a huge impact on the performance management. APM more focuses on performance measurement till now. Performance management, this is the most crucial element, sir. What are those? Six Sigma, Kaizen costing, total quality management, just in time, lean production. Let me talk about these things, sir. Quality के बारे में last में discuss करेंगे. Six Sigma is basically deviation. Sir, I am very sorry to say this, but students do not know that there are 2 sigmas. Just like we have lowercase letter and uppercase letters, alphabets. I'm not supposed to say letters anymore. You have lowercase letter and uppercase letters, alphabets, right? In English language, you said this is A, this is A. Similar to that, Greek letters also have lowercase and uppercase, my dear friends. This is uppercase sigma, this is lowercase sigma. Uppercase sigma is basically sum, lowercase sigma talks about deviation, standard deviation. Unfortunately, many students don't know this. It's good that you guys know and there are answers in the chat section, which is good. It was in statistics. Oh, okay. So very few people have statistics in their graduation and post graduations. But if you do not know it, this is a place for you to learn. So Six Sigma is not about 6 sums. It is about 6 standard deviations. I'll leave it at that. I'll not go into the depth of it because in my regular class, you can find it out. The 30-minute lecture really helped actually. Okay. So there is a 30-minute lecture on why it is called 6 Sigma. What is the purpose of having 6 in that? So 3 sigmas on the left side of the chart, 3 sigmas on the right side of the chart, how the deviation actually calculates 6 folds. Yes. So that entire explanation is done. Let's not waste that much time. We have 25 minutes for all the topics. I take 30 minutes for 6 Sigma. So let's not go into the depth of it, but understand 6 Sigma focuses on efficiency. 6 Sigma focuses on effectiveness. Sir, both? Yes, both. 6 Sigma end result is that you should have less than how many? 3 defects in 10 million products. If you're producing like 10 million units, there should be less than 3 defects in that. So imagine, sir, 1 crore products, only 3 are defective. That much level of effectiveness you should have. That is what 6 Sigma says. How do we reach there, sir? There are steps involved in that. If you are dealing with a new product or if you are dealing with an existing product, there are 2 different methodologies for 6 Sigma. One is DMAIC and the other one is DMADV. You can learn more about it, but not relevant for ACCA APM examination. Do not need to worry much about it. 6 Sigma focuses on increasing the effectiveness by improving the efficiencies, and the effectiveness is number of defects in the number of products that you are producing should be almost all equal to 0. Almost all equal to 0. Next, coming to Kaizen costing. Sir, what is Kaizen costing? Kaizen is basically a Japanese technique. So Kaizen talks about, very crucially, very simply speaking, Kaizen is all about, target costing is one method we use in Kaizen costing. Kaizen and target are 2 different things. Kaizen costing, a Kaizen technique, it's not costing. Kaizen technique is all about small incremental continuous improvements. So 4 words are given here. Pay attention to each word. They are small, incremental, additional, continuous, ongoing improvements. 1 step at a time. You start at 0, you go to 1, 2, 3, 4, 5. But that growth should not stop. It should be small. Sometimes if you get a big stage, big change at one shot, it's good, no problem. If you have like a life-changing event happening suddenly, that's okay. But excluding such exceptional cases, on a regular basis, your business, your processes, your product should have small incremental continuous improvements. Sir, I am there. I used to take offline classes. Then there were students in other states and other countries saying that, sir, we would like to attend your class, but then we cannot travel all the way to Hyderabad to join your class. I still remember there is a girl who traveled from Kerala to Hyderabad, stayed here in a hostel for 45 days. Back then I used to take SBR for 35 to 45 days. She stayed in Hyderabad in hostel and then only to attend my lecture, only to attend my SBR classes. I felt bad. Basically, I should have given her some kind of support, isn't it? So I said, okay, you know what? Next paper, you will not be required to come here and stay here to attend my lectures. We will do it online. So what we did, regular class, we used to put Skype over there and I used to teach. She used to attend on Skype. Then slowly we changed the technique of teaching. Instead of using the whiteboard, because Skype mein you cannot see it as clearly. So what we did, I used to teach on screen, like basically using my touchscreen laptop and all. Then I added writing pad because touchscreen was also a little bit difficult. So I had to shift to a writing pad so that I can make it more easier. Then screen sharing software started. I still remember there was a day when I used to share my screen with my students via AnyDesk or TeamViewer, because back then this Zoom and all were not so popular. And even if popular, they were too costly. So what we had to do, we used to share my screen on AnyDesk or TeamViewer, and I used to call the students and they used to listen to my lecture while looking at the screen. So whatever, based on the technology that is available at a point, so we are doing that. So then later we understood that Zoom aa gaya, to live classes ban gaya. Then timing difference is there. So we came into recorded lectures. Then the problem of piracy and all started. Students were sharing the lectures with each other for free, like time pass pe share kar raha tha. So I had to put restrictions, I had to put encryptions. Then students were like, sir, software, installing the software, entering the encryption key, it is a little bit difficult for us. So then we went with a dedicated server, streaming, whatnot. So at each phase, I can say over the last 3 years, the way I deliver my lectures has changed a lot. And it is small continuous improvements. It is Kaizen, as simple as that. Kaizen is small, incremental, additional improvement should be there over than what we already did. Something new over and above what we have already achieved. It should not take us back. It should only move us forward. Continuous improvement should be there. That is what Kaizen is all about. We use target costing as a methodology to implement Kaizen. Right? Good. Next one is TQM, sir. Total Quality Management in your organization. Please understand one thing. TQM is basically total quality management, means every step in your business, every single resource of your organization should be qualitative. Means what, sir? Less defects, more efficiency, more effectiveness. And that is applicable for total quality all over your organization. Watchman se leke CEO tak, from the watchman to the CEO, from the dustbin to $1 million server. Every resource in your organization should be optimally used. Things should go right the first time itself. It's not like you can produce 10 product, one product 10 times and the 10th time you got it right, so I'm very happy. No, you should get the proper one even in the first try. That means you should already have the top level quality before starting the production. So that much level of efficiency should be there in your business operations. That is what total quality management is all about. We actually had Kaizen workshop in high school. Good for you, sir. Sir, I really hate Indian education system for these reasons. Yes, I love it for some obvious reasons, but then I really wish students are exposed to more hands-on, practical, real life things. I do not really see the reason why there are differentials, integrations taught to intermediate students. I have been in commerce field. Let me say it out loud, sir. Let it be out in the public. I scored 95%, I believe. 946 is my score in +1 and +2 combined. That is 94.6, 95% approximately. So you can assume that I'm in one of those toppers, right? 95% is good enough. So I'm damn good at math. I scored 99 and I was pissed off at myself because I should have scored 100 on 100. I love math back then. And I have done 8 qualifications in commerce today. CMA, CSCA, ACCA, Diploma in IFRS. I'm a member of Institute of Financial Accountants of UK, Institute of Public Accountants of Australia. I did my master's in M.B.A. I did my M.Com. I did 8 qualifications in commerce till date. It's been 10 years. This is the 10th year after my +2. I haven't used integrals or differentiation or all those theories, theorems of properties, trigonometry. None of these topics I have used today, till today. It's been 10 years, 8 qualifications, 6 years of teaching professional qualifications. Nowhere I have used trigonometry or integrals, differentiation, or all those theorems that we did, proofs of theorems. I don't know why we learned all that nonsense. Calculate, yeah, we will use calculus, sir. It's helpful, it's fast math. It is okay. But then these things, like useless things, are taught to us. What's the purpose of that? I do not understand. And then they keep saying that we do not have sufficient time to teach the students this much vast syllabus. You are putting hell lot of crap in the syllabus and wasting students' real thinking capacities by trying to learn those useless shit. Instead of that, you could have put the same concepts which are practically used. You could have added more practical sessions in the students to the students. But yeah, no, they will not do that. They don't teach us how to file our taxes properly in high school. Not just in India, yeah, nowhere they'll teach how to do taxes. In India, if you see, taxation is a booth actually. Taxation is actually a booth. It's scary for people. You know, you say income tax. I still know people who start shredding their shoulders when they hear the word income tax. They think something is going to happen if income tax word is used. It's like that, you know, in entire Harry Potter series, they always keep saying that you know who, you know who, you know who. They'll be like, if you take the name, the demon will get more stronger by the day. People in India are like that. They think that if you take the name of income tax, something wrong will happen. So yeah, the more practical things should be there. Students should be taught more practically. But then there's nothing that we can do to change the things at a national level, or at a we can say more like a, so, you understand it, right? Like an institutional level changes I cannot bring in. So what I do is, sir, I'm not a person who is more interested in just saying it out loud and then not doing anything about it. So for my students, at least to the extent that I can do, I always make sure that the basics are damn strong, and the cases that we do in the classes are all practical examples. That is one thing that I do to at least to support my students, so that they can vouch for it. My students can definitely vouch for it. If I see, just for an example, I am just going to the audit index file. You guys, we all learn audit reports in audit and assurance, right? But if you see, actually in our audit, this thing, you have going concern implications. Sir, an entire lecture on going concern. This is just 10 minutes, not this. This one, yeah, 34 minutes. Modified opinion is there. So on this, in this 34 minutes of lecture, I have actually taken Indigo Airlines, I believe, or else AirAsia. I don't believe which airline company it was. That these lectures were recorded at the time of COVID, the most happening one. So modified opinion with regards to going concern was there on airline companies. Most of the airline companies were facing issues with going concern, right? COVID ke time pe airlines, they have less business, no business, to be honest. So at that time, I actually showed my students what the audit report looks like, how the auditors modify their opinion, what will be the impact of that, what are the practical implications involved in that. So all that stuff I show to my students, trying to keep it as practical as possible while balancing it with the exam point of view as well. So yeah, at least that much students, faculty should do to their students. That's what I believe in. Anyways, moving further. So we have done till total quality management. The next one is just in time. So just in time is all about a pull based system rather than a push based system. Moving from push based system to a pull based system. If I give you a simple example, push based system means you go to some websites, you do not do anything basically. You are just scrolling and suddenly there will be 5 pop-ups on the screen. Enter your email address to download this amazing booklet, or give us your details and we will do the work. So some random things, you'll just have the pop-ups pushed onto you. They are pushing the product onto you. Inappropriate ones, yeah. But pull based system is basically where the website is just plain information. If you need something, you click on it, then only the information will be available on the screen. You need to pull the data from the website. They won't throw it at you. So even if you go to our websites, I am telling you, I have been teaching this, so I practically implement that. You go to our website, no pop-ups will be there to subscribe to that or do this or do that. I mean, I had to do that once when Prem sir was using our website to post blockchain related use cases. So he's like, can you do a pop-up subscribe form so that they'll get on email when I do a new release. But then again, I asked him to create a separate website for his things, and then he switched to a different website and we removed that pop-ups. So our websites will not have any pop-up. So websites, yeah, websites only, unfortunately. Globalfinex.in master page is there, acca.globalfinex.in ACCA related page, cma.globalfinex.in CMA related page. Then we have separate page for services. We have edu.globalfinex where we teach skills to our students, Excel, robotic process automation, Then there is a course on QuickBooks. There is a course on Tally, the skill set basically. So like that, we have different websites for our students anyways. So push based means where we push the product onto the user. So we produce it and then we market it, we advertise it and we sell to the end user. Pull based system means what? End user will tell us that, sir, we need this. Dear business, we want this. So based on their request, we will start the production. Since we do need to do the production, we will ask our suppliers to send the material. So it's a pull based system. It works from the other way around. So just in time tries to basically reduce your inventory storage period, reduce your storage costs, and then increase your efficiencies and effectiveness. That is just in time. But please remember, just in time will work only in very few cases where there are well established business relationships with suppliers. So customer already placed an order. I need material to produce that product. I purchased the product. Later, I purchased the material, raw material and all. Later, I found out that raw material were not suitable for my production. Again, I called the supplier. He said, "Acha, okay, fine, send it back. I'll send different material." Do you think customer will wait till that time? There will be complaints. There will be dissatisfaction. Reviews will be bad. All that stuff will be there. So what will happen because of that? Our business image will be lost. So just in time will work only when you have very strong relationship with your suppliers. Things should happen on phone call or things should happen over a WhatsApp text. If you can drop a message to your supplier and if the actions are being taken, then just in time will work perfectly. We take the example of Toyota. So Toyota, what they did, so wherever they have service centers, they made sure that their suppliers have at least one sales point within a 10 kilometers radius or something like that. Just understand it as an example, not the numbers. Do not focus on the numbers. They're like, suppliers, let's have a proper agreement. So if we build a service center in this area, within 10-kilometer radius of that service center, you should have one store where we can go and purchase the required raw material, required tools or whatever it is. So then just in time will definitely work. But that will work only when you have good relationships with your suppliers, right? And the last one is lean production. So what do you mean by lean production? Lean means less. So under lean production, we are talking about producing, just a second. Okay. So lean product means we are talking about producing in small quantities in more number of batches. So instead of producing 1,000 units in one batch, I am producing 100 units in 10 batches, or I'm producing 10 units in 100 batches. What will happen because of that? Simple, more quality can be assured. So instead of teaching 1,000 students in a single classroom, if I'm only teaching to 10-20 students, I can pay more individual attention to each student. Obviously, quality will be improved. So that is called lean production. But lean production also says that, sir, but if you are teaching 10 students at a time, don't you need like so many resources, so many faculties, so many batches? Yes. So lean production says all your resources should be trained in such a manner that they can perform multiple tasks. So suppose, imagine like this, there is an assembly unit, car assembly is there. So to assemble one car, one guy is experienced in fixing the stereo, music system, all that dashboard basically. Another guy is very good with the hood, the entire engine and all that stuff. There's another guy who is an expert in fixing the tires, alignment of the tires and all that nonsense. Another person is good at fixing the seats and all that stuff. So to produce one car, to assemble one car, you will need 5 or 6 people. But lean production says that train your resources, train your employees in such a manner that one person can take care of all the activities. So with the same 5 resources, now you can produce 5 cars, you can assemble 5 cars. Instead of one car taking 5 resources, one car will take only one resource, so you can run 5 batches at the same time. So if I have 10 faculties who are teaching one subject each, instead of that, if all the 10 faculties can teach 10 different subjects, number of the batch size can be reduced. That is what lean production says. And then lean Just in time, TQM and Kaizen, Six Sigma, all of them can be used by same companies. Don't think that if I'm using Six Sigma, I cannot implement just in time. You can do that. You should do that also. Then you'll get more efficient results. Are we clear with all the strategies? Quality means being free from errors, fit for usage, meeting the customer's need. All of these are different definitions of quality. So management system will be there. Quality related cost. Prevention cost means cost that we incur to prevent failures from happening, like designing and control procedures, etc., all that stuff. The pre-production process, the cost you incur to prevent errors from happening. Appraisal cost means inspection cost and all the costs that we incur to make sure that any errors are identified. Let me write it here. So you have prevention, appraisal, internal failure, external failure. So these two are called compliance costs. Complying with the quality requirements, these two. And these two are called non-compliance costs. Okay. So prevention cost means these are all at the time of preventing the cost, preventing any failure. So we can say these are like designs, or else at the time of what do you call it? Implementation of control procedures, all that stuff will come under prevention cost. Appraisal cost means inspections will come here. To figure out or identify any failure. This is incurred to identify failures. This is incurred to prevent failures. Then, sir, even after doing this too, if you still fail, even if there are, after doing prevention and appraisal, still there are failures. Internal failures means within the organization, we found out that there are some deficiencies or defects. So these are like redoing the production process. Like suppose a product is bad, so we try to repair that within the factory and then send it to the user. External failure means warranties and repairs. So those are your 4 costs associated with quality. How are these tested on the APM by them? Okay, they'll be more like this company is there, so this is what they are doing. They are purchasing goods from this XYZ supplier. It is taking 10 days to receive the goods, so they are selling to the customer, blah blah blah. So do you think just in time can be implemented in this organization? If yes, what is the process of implementing just in time, and what are the advantages of and disadvantages of implementing just in time? Is it really suitable for just in time to be used? What are the problems that they might face while implementing just in time? What could be the solutions to those problems? That could be the pattern of testing it. So then you have Six Sigma DMA-IC. Sir, I told you there are 2 Six Sigmas, right? There is DMA-IC and DMA-DV. So only DMA-IC is tested in your exams, it seems. Yeah, DMA-IC is covered. Define, measure, analyze, improve, and control. DMA-IC. Define the process, measure the existing problems, analyze the process, improve the process, control the revised process. So these are the six sigmas. Then talking about Kaizen costing. So Kaizen, I already told you, right? So that is a small incremental. See, look at the words, exact words will be used. Small, incremental. Cost reductions means improvement throughout the process of the product's life cycle. Small, incremental, continuous. So I said continuous, which means throughout. Cost reduction is improvement. That's what basically. So target costing, you set a target, you calculate the actual cost. I'm so sorry. You set a target selling price. From that, you deduct your required profit margin or markup. Then you will get the target cost. Compare it with the actual cost. You will get the cost gap. Then you will try to reduce the overall cost gap. That is target costing steps involved. Then TQM is about preventing the errors before happening. I told you, first product itself should be good. You should not have 10 mistakes and then find out a good product. No, it should not be like that. Real participation by all. I told you, key, every person. Watchman se leke CEO tak. Management should be committed. There should be continuous improvement. That is TQM. Lean production, basically producing smaller batches, leading to quick setup, more flexibility, empowering staff, giving them career path, a job for life, because you know all the skills. I told you, right? They should know all the skills. So job for life will be there. See, employees should be trained in all aspects, resulting in flexibility and problem solving. Supplier expertise will be harnessed, fair pricing will be agreed, just in time will be operated. I told you lean should be used with just in time. Customer flexibility will be delivered. Feedback is valuable, so you will get better feedbacks. So the 5S concepts: structureize, systemize, sanitize, standardize, self-discipline. These are just basic things. There's nothing beyond and above that we need to discuss in that. So that brings us exactly to the end of the syllabus. The time is 7 p.m. Shabash. We are just over by 3 hours than expected. 7 p.m. to close the. Okay. So before I wind up, any general doubts or anything specifically you guys have? Great. Thank you. They didn't bother with this annuity depreciation in the pocket notes. Is that being removed from the syllabus? No, it's not about removal from the syllabus. I told you, right? Annuity depreciation, isn't it covered along with MIRR and all? I told you, MIRR related problems you have to go and check. Yeah, it is in MIRR topic only. Both the sessions were great. Thank you. I read few models in kit like Z and K model. We don't have them now. Yeah, it has been removed from the syllabus now. Sir, your entire topic on corporate failure has been removed. Literally eye-opening. Thank you. Sir, corporate failure topic has been removed, and please, I have shared a video on YouTube, guys. थोड़ा सा channel को subscribe करके देखो, look at the videos in channel. Sir, I do not post any useless videos or marketing videos on our YouTube channel, and all my monetizations are turned off, by the way. Let me do it on record, sir, but got up for your lecture. Achha. Sir, even I was like, sir, literally, I had a puja at my sister's place. I told you guys yesterday, if you remember. I finished it off. I started at 3. I came home at 3:40 and I started your lecture at 4. I did not even have the time to dress up properly. Oh, kurta tha. I was in a kurta, so I had to just change it quickly and wear this random t-shirt that came to my hand. So I did not even get time to do that. Sir, just to show you. See, this is the video. Yesterday's video has been uploaded. Just today morning, I uploaded it. Pura concepts revision. And ACCA performance management syllabus changes related video is there. I'm just trying to copy the link and I'm pasting it here so you guys can also get back and watch this video. So please go through that. And let me just quickly show you something here. There is monetization. And here you can see clearly, right? Monetization is turned off. I can do that with 10 videos if you want. All the videos, all educational videos will have monetization turned off. So this is a proof for you guys. All the ads are blocked. Even though our channel has monetization features, we blocked it out because we don't want advertisements on your videos when students are watching it. It's just a proof. So when I say subscribe to the channel, it doesn't mean I'll get any money from these videos or anything. I was trying to waste time over there. Look at this. Monetization column off. All the videos monetization is off. You can see here. This is YouTube Studio for our channel, Global Finance Channel. So please do your duty. Bye-bye. So that's the thing that I wanted to do. So you guys tell me, sir, what else? If you have any other doubts or any things that you want to discuss with me before we wind up for the day, you can let me know.
Nothing. It was great. Thank you.
So just one quick thing, Ma. I'm sharing this, the thing that we use, what is called the PDF file. So the PDF file that we used in the session, the pocket notes. I cannot. Okay. I cannot minimize this. It seems Zoom is not minimized. Okay. So I'm sharing the handwritten one. I made some annotations on the quick notes. So if in case you guys are doing revisions using that annotated quick notes, you can get it from the Zoom thing. If later, if people are watching this on YouTube, I'll give the description. I'll give a link in the description you guys can download that file. No big deal. Okay, quickly guys, anything else? If nothing, then we'll call it a day, and good luck for your exams. And more importantly, pay attention to your health and stay safe. Okay, that's more important. So cool, nothing, thank you. Okay, then let's call it a day then. All the best for your exam, guys. If in case you have any doubts or anything, or if you want to reach me, you can ping me on WhatsApp. I'll be available on 832-8080-730. The number is 832-8080-730. You can ping me on WhatsApp. This will be our admin number. This is actually our academy number, but most of the time the phone will be with me only. So I can respond to you whenever I find time. Right? So let's call it a day. Bye-bye, guys. In all fairness, thank you for this. Thanks for spending your time for us. My pleasure, guys. See you all. Good luck. Bye-bye.